All hawks now. With a surprise hike, the ECB ends 8 years of negative rates. Christine Lagarde says surging inflation made it an easier call. Uncertainty in Rome. Italy will choose Mario Draghi's successor on September the 25th as political uncertainty and economic concerns mount. Stocks and BTPs pay the price. Snapping the rally. Snapchat's parent misses on revenue, sending the shares plunging after hours and weighing on Asia tech stocks and US futures today. Let's check in on the markets then. After 3 straight days of gains stateside, yes, you had the disappointment around Snap, and that weighed on the likes of Meta as well. But it was the gains that we saw towards the end of the session on Wall Street, 3 straight days. And globally, you are still looking at the best week for global markets in about a month. Whether that can be sustained, of course, remains the question. We had some data out around retail sales here in the UK coming in less badly than some had expected than the forecast. That was for the month of June. You're currently seeing gains, losses, I should say, of about 0.1% across the FTSE 100. The Spanish IBEX range bound. We're looking at the banking sector there. Santander walking away from a potential deal in Mexico, but also a levy being imposed by officials in Madrid. And we'll see how the banks react to that and adjust to that as they look to maybe using tax credits to offset some of that hit. The German DAX is currently lower by 0.5%, and Spanish IBEX, again, down by just 5 points. The CAC current lower by 0.4%. Investors still adjusting to this more hawkish ECB then. 50 basis points and the unveiling of that TPI anti-fragmentation tool. It will come down, the experts say, to implementation of that tool. Whether or not Italy fits the criteria is another open question. Let's switch it on, see how things are playing out then. Given what we saw yesterday on Wall Street, there were the concerns as well around economic data. The jobless claims came in higher than some had expected. Factory orders as well, looking a little softer stateside. So underscoring some concerns around the recessionary risks for that economy. Futures, when it comes to the NASDAQ, that tech-heavy index, currently pointing lower by 0.7%. Again, digesting those very bad results from Snap. Euro-dollar 102. You saw some solid gains yesterday on the back of that bigger than expected hike. But that's come off now, 0.2%. The dollar is bid. Italy and the 10-year BTPs, 351. Not a lot of movement, but of course you did see a rally in yields yesterday. They came off towards the end of the session as investors digested the implementation and the implications of that anti-fragmentation tool. Brent crude currently at 105. That's a gain of 1.6% for oil. Let's get back to the ECB then, doubling the expected size of its first rate hike in more than a decade, saying the economic data will determine the size of future moves.
We expect inflation to remain undesirably high for some time, owing to continued pressure from energy and food prices and pipeline pressures in the pricing chain.
For more, we are joined by Bloomberg's Jana Randa, of course, was watching all of this, charting all of this for us yesterday. Jana, why the last-minute change of heart then? We heard that some officials within the Governing Council were pushing for 25 basis points, then they all coalesced around 50. What was behind that surprise move?
Yeah, certainly some policymakers were initially in favor or preferred to stick to the forward guidance the ECB had offered in the run-up to the meeting. But in the end, it came really down to inflation. The president said very clearly that some of the risks the ECB identified at its June meeting actually materialized, and they saw that that price pressures will remain undesirably high also in the future. And one thing that really helped them make that decision to go in big, to go in bold, and to follow the path that other central banks have taken over the past weeks and months, was the creation of that TPI, that transmission protection instrument that will allow the ECB to make sure that policy is transmitted to each and every corner of the region, that there is no disorderly reaction in bond markets, and that's what made them feel strong about going in big yesterday.
Yeah, but it's something for everyone. The doves and the hawks having their concerns addressed by the announcement yesterday around the anti-fragmentation tool and, of course, that 50 basis points. What have we learned about this TPI tool and when it may be used?
Yeah, so there were a few details, of course not every detail, which was to be expected. The biggest message probably is that there are no ex-ante limits to this tool. So for now, the ECB is prepared to go in big if necessary. It's going to focus on the public sector market, though it said private sector purchases could be an option if warranted. Maturities will range from 1 to 10 years, so that's slightly different from other purchase programs the ECB has run in the past. It will accept pari passu status, which means the same status that creditors or other investors take should there be a bond restructuring, which of course is not to be expected in the Eurozone. And the most interesting was probably the conditions the ECB set out. They all relate to sound fiscal policies. The ECB will make that judgment with the help of targets laid out by the Commission, by a sort of international organizations. And it's very much at the discretion of the ECB. The President was very, very clear on that. She also said the policymakers will not hesitate to use the tool if needed, though she also said they prefer to keep it on the shelf.
Okay, Jana Randall, yeah, she prefers to keep it on the shelf, but will not hesitate to use it if, of course, they and the Governing Council see the need. Thank you very much indeed for bringing us the latest in terms of that ECB move and that anti-fragmentation tool. Still waiting for more details, of course. Let's get into the key market drivers then with Madison Fuller, Vice President and Global Market Strategist at JP Morgan Private Bank. Madison, we want to talk, of course, about what we've seen across global equities, something of a rebound this week. But let's start with the central bank action then. Your take on this decision by the ECB and where it leaves your view in terms of the rate trajectory for the Central Bank of Europe and ultimately where rates end this year.
Perfect. Thank you for having me. So when I think about this rate move that we just saw, I think this 50 basis point hike wasn't as hugely surprising as it could have been, given that it was, one, a bit leaked, and two, the ECB has been so far behind the curve. I think the unveiling of the anti-fragmentation tool likely gave the impetus to be a little bit more aggressive with that rate hike than that 25 basis points that was originally being debated. I think, like the Fed, it's very clear that the ECB is intent on, really fighting inflation and doing it at the expense of economic growth. And so I think it seems like the ECB is more likely to front load these rate hikes to preserve optionality for later meetings. And I think that was also reflected in the removal of the forward guidance that we saw. Ultimately, we expect ECB deposit rates to, reach around 75 basis points by year end. But I think, the risk is skewed to the upside with that.
Okay, 75 basis points by the year end. We're looking back at history, 2008, 2011, when the ECB hiked rates and then shortly afterwards had to move back and reduce rates once again. There's the idiosyncratic reasons, of course, and we're facing a very different economy today. But is that the risk that the European Central Bank is trying to pull forward these rate hikes, but in fact, you're hiking into recession and they're going to have to walk them back pretty quickly?
Certainly, I think that very much is the risk, and it's the same for the Fed as well. That risk of over tightening, I think, is very much a real possibility, which is why I think when it comes to recessionary risks, both for the U.S. and Europe, it seems more like a coin flip probability at this point, whether you kind of get a soft landing or you get a recession. I think, looking forward into 2023 for the ECB, it's more likely that they end up delivering less than what the market is pricing in total, given the effects that it's going to have on slowing growth.
Okay, Madison, what do you make of this TPI tool? The acronyms coming out of the ECB, just another one to add to the alphabet soup there. How much of a head fake is this? How much of a bluff is this from the ECB? Are you convinced that they really, and this tool really has the teeth to deal with the kind of blowout in yields that people are so concerned about when it comes to Italy, Spain, and others?
Sure, of course. And of course, the context for this tool is that, the ECB has the added complication relative to the Fed of tightening policy without hurting those indebted nations like Italy. I think broadly speaking, the anti-fragmentation tool, the TPI, it doesn't seem like a cure-all. And I think that was really reflected in the wider BTP boon spreads that we saw yesterday. Ultimately, it's not clear if it'll ever be used. The details are still scarce and unclear. And I think its use really, again, depends on the severity of the risks, which I think can be really difficult to measure. I do think policymakers are very serious about confronting the risks, but I don't think the market got all the information that it was really seeking from this latest meeting.
Okay, still looking for a little bit more clarity on the details of this TPI tool. Currently yields lower on BTPs, both at the front end and the long end. At the long end, down by around 4 basis points, in terms of 5 basis points, in fact, with the Italian 10-year at 3.49. Madison Fuller stays with us, Vice President Global Market Strategist at JP Morgan Private Bank. We'll get more of Madison's calls after the break. Coming up, tech stocks get knocked down in extended trading after Snap sales disappoint. Tech in focus next. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Welcome back to the Open. We are 12 minutes into the European trading day. Happy Friday. You're seeing losses of about 0.1% across European equities. Stateside, futures on the S&P looking lower by 0.2%. NASDAQ futures down by 0.6%. Talking of technology, Snapchat's parent company, Snap, plummeted 27% after disappointing revenue raised concerns about the outlook for online advertising. Meta, Alphabet, and Pinterest all fell on the news. It was the second time in 2 months that Snap drove a tech sector sell-off. Still with us to discuss is Madison Fuller, Vice President and Global Market Strategist at JP Morgan Private Bank. Madison, what is your assessment then of the tech sector? You say that there are opportunities in reasonably priced parts of tech. Where are we in terms of multiple compression, and how concerned are you about the earnings we're starting to see come through?
Sure. So I think the technology sector is really reflecting this higher cost of capital And as a result of that, tech is still, broadly speaking, quite a difficult environment. I think we're seeing, again, some of these companies not only profit warn, we're also starting to see them suspend or cut their hiring plans. But I think what's really important to note is that some firms have more risk than others. We're seeing more risk from those that unprofitable tech category, or those caught in the crosshairs of slowing electronics demand or supply chain constraints. And so we really see the most opportunities specifically within the software space, where you have some of these more consistent, stable earning streams. And so again, ultimately that comes back to focusing on those companies that are still providing growth at a reasonable price. So really being, I think, valuation aware when we're making these decisions.
Okay, valuation aware when you're making these decisions. The other sectors that you like, healthcare and industrials, talk to us about that and whether or not cyclicals now have come to the end of their shelf life, given the recession concerns.
Sure. So I think especially now the fact that we have these rising recessionary risks, we definitely want to be skewed more towards quality and defensive areas of the market. So you really want to be stepping away from more of those traditional cyclicals like financials, like materials, areas like that. And again, healthcare, for instance, is really positioned as a defensive sector. It has had consistent earnings growth even through the global financial crisis. And it also has that exposure towards longer term growth and innovation as well. When it comes to industrials, yes, that's a cyclical sector, but I think a lot of industrials are also backed by these secular tailwinds around automation as well. So those are other two areas in addition to the reasonably priced technology segment that we're the most convicted in.
So I'm interested in your call to move away from financials in particular. Does that suggest that you're starting to see, your assessment is that yields in the US have started to kind of top out at these levels?
Yes, certainly. And I think we're seeing that, really play out in the market dynamics over the course of the last few months. We saw, 10-year Treasury yields rise well north of 3%, and they've started to, come back down over the course of, the last few weeks, as I think that negative economic feedback loop has started to really pressure longer dated yields. And so as yields start to come back down, that does suggest that yields are have peaked or are in the process of peaking, which I think also leads us to a really interesting conversation around legging into fixed income right now as well.
And talking of fixed income, we have some data coming through when it comes to the Eurozone economy. So July manufacturing PMI for France coming in at 49.6. It's a pretty decent miss versus the forecast. Decent is probably the wrong word to use there, but it's 49.6. The forecast was 51. That's July manufacturing for France. Services PMI also coming in softer. Of course, there's a view that you're going to be switching from manufacturing to services as the economy adjusts post-COVID. Services PMI coming in at 52.1 versus 53.9. So it's a miss both for services and manufacturing for French July PMI. We've also had some commentary around the ECB as well. Villeroy of course, the Bank of France saying that the TPI, so this anti-fragmentation tool, is a sign that the ECB is credible on normalization roadmap. So just an update there as well. Another redhead crossing the terminal, Germany in the final stages of bailout deal for Russian-hit Uniper. We knew that was going to be put on the desk of the Chancellor, Olaf Scholz, today. Madison, I've gone through those redheads for our viewers and for yourself, but let's get back to what's happening just broadly before we let you go across these markets. You don't think that we're at full capitulation at this stage then? 3 days of pretty decent gains stateside, but you think there's further to go in terms of pressure across these stocks?
Yes, I think, this is a very well telegraphed potential recession risk. And so risk assets, are well on their way to pricing in more of this negative news. But I do think, a full recession is not priced into markets. Markets could move lower. But that said, for long-term investors, I still do think that these levels look compelling. If I think about where the level at which I might, close my eyes and just buy broadly, I think that's about 3,500 on the S&P 500. That's, a 27% fall from January's highs, which is, consistent with the average mild recession over the last 70 years. But at the same time, again, that's another 12% decline from current levels after this week's rally. So I think we'll probably get a sense for where that inflection point might be once we get a sense of a shift that the Fed might be making, and that may come later this fall.
Okay, close your eyes and buy at 3,500 on the S&P. It closed yesterday at 39.98. Madison Fuller, great takes, thank you. Vice President and Global Market Strategist at JP Morgan private bank. Okay, coming up, UK retail sales fall less than expected in June. As food spending jumps, we look at the economic picture, the health of the UK economy next. This is Bloomberg.
Happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Welcome back to the Open. We are 20 minutes into the European trading day, seeing losses of 10% across a tenth of a percent, not 10%, a tenth of a percent across European equities. S&P E-mini spawning lower by 0.3, Nasdaq futures lower by 0.6%. Let's check in on some of the stock movers of the day, of course, as we adjust and take on board some of the earnings. Santander, this is not an earnings story. This is about them walking away from a potential bid for the cities unit over in Mexico. They're not going to be pursuing that any longer. That's Banamex. So Santander walking away from that non-binding offer, gaining at 1.8% on the back of that. Norsk Hydro, it was a beat. We're going to be speaking to one of the executives from that business in the next hour or so, gaining, as you can see, 3.7% on the back of a decision to hand back cash to shareholders in terms of buybacks and dividends as well. SSAB, this is a maker of steel products, down 0.8%. It was a beat on the second quarter, but warning about pressures and a challenging market for the third quarter. Right, let's get the Bloomberg Business Flash now with Alice Atkins. Alice.
Hi, Tom. One of Elon Musk's top lieutenants is said to be under internal investigation for his role in a plan to purchase hard-to-get construction materials. Omid Afshar is the executive running Tesla's Texas factory. Sources have told Bloomberg that Tesla plans to part ways with Afshar, but the terms of his exit are still being worked out. Some employees have already been fired over the investigation. Amazon is starting delivery of packages to US customers using the first of as many as 100,000 electric vans built by Rivian. Amazon expects to have Rivian vehicles deployed across more than 100 cities by the year end. Amazon has delivered 430,000 packages using Rivian pre-production vans since 2021. Speaking on Bloomberg TV, Rivian CEO confirmed plans to cut 5% of non-manufacturing roles.
These are some of the hardest decisions a leader has to take in running a business, and certainly we're trying to be as intentional and as thoughtful in in terms of what that means for the business, what that means for the individuals as we work through that process. But as you said, this doesn't impact our manufacturing teams. This is really more heavily in some other aspects of the business.
Mattel says second quarter margins shrank due to inflation, higher supply chain costs and royalty expenses. Gross margin shrank to 44.4% from 47.5% a year earlier. However, profit and sales were a beat driven by demand for action figures. Chief Executive Officer Ynon Kreiz said he still expects growth in the second half and next year. That's your Bloomberg Business Flash. Tom?
Alice Atkins here in London, thank you very much indeed. Now, data out this morning shows UK retail sales fared better than expected in June. Even so, consumer confidence is languishing at a 48-year low. That is according to a separate report from GfK that showed the broader impact of soaring inflation here in the UK. Right, joining me now is Bloomberg's Lizzie Burden to break all this down for us. Lizzie, what are some of the key takeaways for you? What stood out from this data?
Well, this is slightly better than expected, but it's still a slight drop in retail sales. And what it reflects is that the cost of living crisis is weighing on consumers. You can see it in the GfK survey, which is very gloomy. It says that consumers are severely depressed about the outlook. But that's sort of rehabilitated in the retail sales by the spending on food because of the Queen's Jubilee weekend bank holiday. That gave it a bit of a boost. In terms of what it means for the Bank of England at its August decision, I don't think this moves the dial really, Tom. You've already had the inflation data this week, showed it's a new 40-year high. You had the jobs data. So even though we've reached peak tightness in the labour market, it's still very, very tight. And even the ECB is going for half-point hikes at this point. So really, 50 basis points from the Bank of England looks pretty locked in.
OK, that looks locked in. Doesn't really change or move the dial for the BOE and Andrew Bailey. What about the politics of the UK and the polling around who is likely to be the winner? We have two contenders now to take over from Boris Johnson.
Yeah, indeed. Liz Truss, 24 points ahead in the latest YouGov poll. Rishi Sunak's going to be hoping that over the next 6 weeks he can turn that around. He's got 2 TV debates coming up, lots of hustings over the summer. It's still the debate focusing on the economic arguments. And really you could ask whether Liz Truss is that radical. Controversial this, but the Centre for Economics and Business Research says that there is £60 billion worth of headroom for tax cuts. Perhaps that's too optimistic. Maybe the OBR, the Office for Budget Responsibility, would change its position now on headroom given the recession risks. But also in Truss's favour is the OECD argument that it's this premature fiscal consolidation that's led to the recession risks. So that's what Truss is arguing on the airwaves, that you should trust her with the economy. Whether she can convince investors of that, we don't know, because they're worried about her position, not just on tax cuts, but also about Brexit and the Bank of England. They're saying that a Truss victory would ward investors away from not just sterling, but gilts as well.
OK, interesting. And we still don't really know, arguably, who the Foreign Secretary is. She's the lead contender, but she had views on Brexit. She was, of course, changed those views. She was a Remainer and then changed to be very pro-Brexit. She used to be a member of the Liberal Democrats. Now, of course, she's on the right of the Conservative Party. So it's difficult to get a gauge of exactly what she stands for. There is that gap, and he's going to have to work very hard, isn't he, Sunak, to make up that gap.
Total chameleon, and she was the ultimate Johnsonian, loyal to the end. But don't forget, she was the ultimate Cameronian before that. So Liz Truss changes her spots. Who is she really? That's the question we'll hope to get in the TV debates.
Great stuff. Thank you very much indeed, Lizzie Burden, of course, on the politics of the UK, the changing fortunes of that leadership race, and of course the eco data as well. Coming up, the ECB ends 8 years of negative rates. Camille de Courcelles, head of strategy for G10 rates in Europe at BNP Paribas, joins me next. This is Bloomberg.
nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. We are all hawks now with a surprise hike. The ECB ends 8 years of negative rates. Christine Lagarde says surging inflation made it an easier call. Uncertainty in Rome. Italy will choose Mario Draghi's successor on September 25th as political uncertainty and economic concerns mount. Stocks and BTPs pay the price. Snapping the rally, Snapchat's parent misses on revenue, sending the shares plunging after hours and weighing on Asia tech stocks and US futures today. Let's check in then on these markets. You're still looking at global markets putting in the best week in about a month. Of course, you did have those concerns about the earnings from Snap, but also eco data out of the US on factories and jobless claims that suggest there is some weakening there and raising again the prospects of recession. Talking of data, we had the PMIs out of France, both misses on manufacturing and services as well. That weighed down on the euro. The euro is lower, but it's worth noting that bunds and PTPs are actually bid in the current session. On a sector-by-sector basis, you've seen oil higher. That's pushing up energies to the top of the list, up 1.3%. That safe haven of utilities getting a bit of a bid as well, up 0.8. At the bottom of the list, you've got construction materials, industrials, and food and beverage as well. A bit of a mixed picture, but broad-based, you've actually seen a move from lower to modestly higher across European equities. A bit of choppiness in the session this Friday. Again, as we adjust to that 50 basis point hike from the ECB and around the details, of course, of that TPI anti-fragmentation tool. We're expecting data out from Germany as well when it comes to manufacturing PMI. We'll bring that to you when we get it. 49.2 is the number, in fact. We have that. July manufacturing PMI out of Germany. 49.2. The forecasts, let's move the prompts up so I can see it. I don't have my terminal in front of me. The forecast was 50.7. So there you go. It's a miss in terms of July manufacturing PMI out of Germany. 49.2 coming in below the forecasts. Euro dollar down 0.7% on the single currency. Again, whether we get back to parity, Madame Lagarde talking about pressures on the euro being one of the factors, along with inflation, that made that decision around front-loading hikes easier, as she said. Here's what's happening across the yield space then. You have 1.095 on the 10-year, the German yield. You're seeing a move into German bunds, but also into BTPs. So yields lower by 12 basis points on the 30-year, 133. Not a lot of movement there, but it's this movement around the 10-year and the 5-year, the front end and the back end, 17 basis point move at the front end of the German yield space as we weigh up that manufacturing data, the PMI data out of Germany, France, and of course the broader picture of a tightening ECB and a tightening Fed. Italy now will hold on an election on September the 25th. The politics of Rome with the centre-right coalition currently leading in the polls. That's after Mario Draghi resigned as Prime Minister on Thursday. Here are some of the reactions we've been getting.
It is a turning point in Italian history. We had a government working very well with the respect of the entire community community, Italian community, not only business community, the people.
The markets are worried, and if the markets are worried, we're worried. Obviously, Italy is a country with massive opportunities. We've got a very strong entrepreneurial category, and I do believe that we've weathered other crises before. We'll weather this one, but obviously it would have been better off if this never happened in the first place.
The Italian people that are running the country in terms of economy, the Italian salespeople, entrepreneurs, we are astonished regarding the situation, because it's the first time in our life that we have a so fantastic gentleman, Mario Draghi. I think the world really loves him. Everybody loves him. And that finally we can have started to have a contact with all countries in the world. We started to have appreciation from the other country that the last 20 years, Italy was not very much supported from the other countries. This is the first time that we have someone really can drive the economy, solve the pandemic. We have also the worst problem, the Ukraine, and I cannot understand why.
It's not good news for Europe, for the West, for Ukraine. And Draghi and our coalition, we were very strong in supporting Ukraine. Italy was one of the most supported countries. We have to keep fighting and keep helping Ukraine.
Meanwhile, the ECB, of course, doubled the expected size of its first rate hike in more than a decade, saying the economic data will determine the size of future moves.
We expect inflation to remain undesirably high for some time, owing to continued pressure from energy and food prices and pipeline pressures in the pricing chain.
Okay, joining me now is Camille de Courcelles, Head of Strategy for G10 Rate Strategy in Europe at BNP Paribas. Good morning, Camille. Thank you for joining us. The data that's come out in terms of France and Germany on manufacturing and services, both countries missing across both metrics, seems to underscore the fragility of the Eurozone economy and the risks of hiking aggressively into a potential recession. What is your assessment of the risks around this move from the ECB?
Yeah, good morning, everyone. The numbers today will only reinforce the fears of a recession in the Eurozone over the coming months, definitely below expectations, below our own expectations. But I would highlight that in our projections, we had Q2 and Q3 being the trough for growth. So it does not necessarily mean that things will not get better in upcoming quarters.
Okay, and what is your take then on TPI, on this anti-fragmentation tool, and whether it is effectively going to be implemented and can cap the yields of countries like Italy? So far, there's been a move into BTPs. It suggests that at least on the surface, investors are relatively relaxed.
I have to say, initially our reaction was that the message in the statement was very strong. It was making the transmission a precondition to the ECB's ability to deliver on price stability. So quite a strong message indeed. But then in the press conference, it soon became quite clear that the new facility is not intended to address idiosyncratic risks such as political jitters. And in fact, that is exactly what we were fearing before going into the event. And Lagarde added, for instance, that the ECB does not take a stance on political matters. She also differentiated the TPI from the older OMT program, saying that the OMT, is for unwarranted disorderly market dynamics related to idiosyncratic risk and redenomination risk. So there is a clear distinction between the two risks and the two programs.
Okay. So, Camille, what does that mean for spreads? 237 currently, Italian BTPs 10-year versus Bunds. That is the spread. Where do spreads go from here?
So we think that from here, the spread can only widen. It can only widen because at this juncture, our perception is that the TPI will not be activated for Italy. So we are in an environment where we have the general election in 2 months' time. We will probably have poor market liquidity over the summer and the TPI, which might not be activated for Italy. So therefore, it's kind of a recipe for wider spreads. And we think that, with the TPI, it was also quite clear that it's more a reactive tool than a preemptive tool. So overall, you would need to see a widening of spreads to a significant extent we would expect before the ECB really step in. So overall, we think that
Italy,
BTP bond spread would go to 260 basis points at least.
Okay, 260. So 260 is the level to watch on those spreads, currently at 237.30. How much, the other risk, of course, beyond the Italian politics is gas and gas flows from Russia to Europe. How much of that risk is priced into European credit at this point, Camille?
Okay, so until recently, we saw that, the credit market had weakened quite significantly. So for us, already pricing a risk of a technical recession. Now, the risk would be that as we go into the winter, perhaps we have some supply disruption on gas. So even though the recent news flow on that front was positive, it does not necessarily mean that the risk of a gas disruption as we go into the winter go away. So the risk is still there. And if we were to enter into a phase where Europe ration gas or Russia halting the supply of it, we could then move into a full-blown recession, in which case we would expect the credit market to price much more than currently is the case. So we would expect wider spreads from here. We would expect the portion of distressed debt to rise from here. And therefore, we have recommended, to have a few recession hedges in our portfolios across assets.
Okay, the need for recessionary hedges given that gas shock. The worst case scenario is not yet fully priced into European credit. Camille de Cossel, thank you, Head of Strategy at G10 Rate Strategy Europe at BNP Paribas. Coming up, the German government is in the final stage of a deal to bail out Uniper, talking of gas, to prevent the collapse of a linchpin in the country's energy network. The details on that story next. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Welcome back to the Open. We are 43 minutes into European trading day. Equities range-bound here in Europe, just digesting some weaker than expected manufacturing and services PMI data for the month of June for Germany and France. Talking of Germany, the German government is in the final stage of a deal to bail out Uniper to prevent the collapse of a linchpin in the country's energy network in the wake of Russia's moves to slash gas supplies. Joining me now is Bloomberg's Frankfurt Bureau Chief Christoph Rauwald. Christoph, what do we know then at this stage about the bailout and when it's likely to be finalized?
Yeah, there will be a key meeting basically today in the German Chancellery in Berlin, where the details of the proposed bailout package will be discussed. From what we're hearing, they are very close to a final agreement. The German government will take a direct equity stake in the company, probably between 25% and 30%, and also agree to a pretty significant financing package worth around 8 billion euros to help Uniper, or to keep Uniper stay afloat.
And Christoph, what does that mean for the business going forward? Do its problems abate then? Is that support likely to be enough? And the broader utility complex within Germany adjusting to that lower flow of Russian gas?
It will essentially buy the company some more time to adjust to the new reality, I guess, on the energy market. Uniper has been heavily reliant on gas imports from Russia. Those have been reduced, and the general aim is to cut the Russian gas imports basically to zero over time. So I think it's probably part of a broader overhaul for the company to basically set out on a new strategic direction going forward.
Okay, Bloomberg's Christoph Rauwald on the closing stages, it looks like, of a bailout by the German government of Uniper. His team was first to flag this happening on Friday earlier this week. Okay, let's get to the Bloomberg First Word News now with Alice Atkins. Alice.
Hi, Tom. Russian shelling pounded a densely populated area in Ukraine's second largest city. Officials and witnesses in Kharkiv said at least 3 people were killed and about 24 others injured. The barrage hit a mosque, a medical facility and a shopping centre. Police said cluster bombs hit a market. Italy will hold an early election on September the 25th after Mario Draghi resigned as Prime Minister. President Sergio Mattarella officially called the vote after dissolving Parliament. Polls suggest a centre-right coalition led by the Brothers of Italy could have a clear majority. But the euro area's third biggest economy now faces months of political uncertainty. Applications for US state unemployment insurance rose for a third week to the highest since November. A growing number of companies have announced job cuts. Labour Department data showed initial unemployment claims increased by 7,000 to 251,000 in the week ended July 16th, higher than analysts' forecasts. The January 6 hearings have been told former President Donald Trump ignored pleas from his advisors and took no action for hours to stop the violent mob storming the Capitol. Panel members say that was because he wanted the rioters to stop or delay certification of the 2020 election results. One former aide told the televised hearing that a Trump tweet calling Mike Pence a coward was like pouring gasoline on the fire. The hearings are set to resume in September. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom?
Alice Atkins, thank you. Okay, coming up, tech stocks get knocked down in extended trading after Snap sales disappoint. Tech in Focus, we'll break out the details next. This is Bloomberg.
see SpiceJet 737 MAX aircraft. That Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think the Fed is raising rates quickly, which is the tool they have, and also telling people what they're doing and being transparent. And if you start to see some adjustments being made, the rate of increase in certain areas has tipped over a little bit, but there's still work to do. In the end of the day, the Fed's toughest job is the fact that it's trying to slow down an economy which has strong employment, strong wage growth, and strong spending. And that's not the usual, that's an unusual case to see all that go on at once. And by the way, with the U.S. being one of the strongest economies in the world. And so I think they've got a tough job ahead of them, but they're using the tools they have, which is to basically raise rates and change the balance sheet, but more importantly, to tell people what they're doing, and you're seeing the markets adjust to that.
Brian, you have so many ways at Bank of America of looking into the U.S. economy, getting a sense of where it really is. One of the big questions is, do we think inflation has peaked? If you were asked that question, what would you say?
Well, I think it'd be different for different areas. So you're seeing in some areas the rate of increase slow down and starting to tip over, but you're seeing other areas, wage growth is still very strong. So I don't think it's peaked yet. And our economists would say it's peaking probably is our team. Our team basically says that the Fed will continue to raise rates, and actually Candace Browning-Platin's team, the research team at Bank of America, has the year-end recession, which they made a call on a few weeks ago. But it's a slight recession, and a recession is not accompanied by high unemployment, which means it ought to right itself and come back out. But it's more the impact of the Fed raising rates and slowing economy. So it's peaking is probably more appropriate than peaked. You're seeing some indicia that's starting to tip over in areas and flatten out. And remember, the way the economists think about it, it's not the $100 to $115 price change. It's the 115 as it looks forward. And I think the expectations are starting to flatten a little bit of future inflation as you hear them come through.
Flat is one thing when it comes to inflation, down is another. And one of the questions is, even when we've peaked and start to come down, how fast is it likely we'll come down? Forget about the end of 2022. What about the end of 2023? What does your team, Candace and the others, say about where they think inflation will be at the end of 2023?
Well, they think the recession, then inflation will calm down. And by the end of 23, you're starting to work your way back up to the 2% type of growth rate in the United States. I think they have 1% toward the end of 23, if I remember right, but still under trend growth. And so it's still recovering. And so that means that they see inflation having tipped over enough that the Fed then pulls back on rates a little bit. So their rate structure, the Fed funds rate actually comes back down a hair towards the end of next year, but it's relatively the same.
Okay, that was, of course, Bank of America Chairman and CEO Brian Moynihan. Now let's get back to what's happening within the tech space. Snapchat's parent Snap plummeting 27% after disappointing revenue raised concerns about the outlook for online advertising. Meta, Alphabet, and Pinterest all fell on the news. It was the second time in 2 months that Snap drove a tech sector sell-off. Joining us now is Alex Webb from Bloomberg Quick Take. Alex, what do the Snap results mean? You've been talking about this on the show, the risks around advertising and how we need to differentiate between those parts of the tech sector that are very exposed to advertising and those that are less exposed.
Yeah, so we know that in most economic slowdowns, the first thing that companies cut is their advertising marketing budgets. So that's where we see the first impact hitting these sort of ad tech stocks, and we include in that, of course, Facebook and Google. Now, Facebook and Google are really at the top of the pyramid. Snap, a little bit further down, Twitter as well, somewhere around there. The thing is with Snap, of course, it trades at a really generous multiple. It trades at 145% before yesterday's earnings, 145 times forward earnings. So that means if there's any wrinkle in the growth story and it's valued as a growth stock, it will get punished, and that's exactly what's happening now. The actual growth in this quarter, they had reduced their earnings, their forecast a little bit. It wasn't as dramatic as all that. It was in the current quarter where they've said that it's flat compared to last year, and that is clearly not good.
And yet they're adding users.
Well, they are adding users, but equally, if people aren't spending to try to find those users, then it's kind of all moot. And TikTok is hoovering up a lot of attention right now. We don't have visibility into TikTok's numbers. They are also looking like they're maybe pushing back their planned IPO. We did have some news from TikTok that they're reporting from Bloomberg that the valuation at TikTok has been cut in private markets essentially. So it's not at all rosy in that social media.
And of course, we're looking ahead to Twitter as well. Earnings out later today. Obviously, advertising an important part of that business, but also, of course, the standoff with Musk.
Yeah, I think that it seems to me they're unlikely to say a huge amount about what is an ongoing court case or a court case about to open. Whether they need to or not, that will be the fig leaf they use in order not to have to talk about it. But there may well have been an impact for the fact they've been in a certain amount of stasis over the past few months because they've had this ongoing, this impending deal, and therefore maybe haven't been willing or able to take as many of the big strategic decisions they might otherwise have done.
In terms of the headcount cuts and freezes and reductions that we're seeing across the tech sector, is anything involved around that? Is it just a given that we're going to see more of that as the economic data starts and continues to weaken stateside?
Yes, I think so, probably, because we've seen the thing is these companies have been hiring aggressively for quite a long time, and it's often been about trying to explore new opportunities. They see a little, new little market segment which provides an opportunity for growth, therefore let's hire to beef that section up. If those opportunities cease to exist, you don't need to be doing the hiring. So it's not just about trimming costs and cutting it down, it's about saying you don't see the opportunities you did before, therefore you don't need the same head count that you might otherwise have done.
Okay, Alex Webb, great as ever. Thank you very much indeed. Bloomberg Quick Take, of course, on the dwindling advertising revenue for some of these companies. Looking ahead to Twitter as well. Earnings out later today. Let's check in then on your markets before we close out the hour. You are seeing a very modest gains across European equities of 0.1%. We closed yesterday for European stocks in the green as well, despite that bigger than expected hike from the ECB of 50 basis points. Stateside, S&P E-minis down by 0.4%. Nasdaq futures lower by 0.7%. Of course, that ties into what Alex was talking about around concerns on tech earnings, particularly what we're seeing around advertising. The data out of Europe as well, still pointing to slowing growth, particularly manufacturing and services out of France and Germany, both disappointing. Pressure on the euro, that is currently down 0.9%, and a move into both bunds and BTPs, a big move into the front end of German bunds. Yields down by 20 basis points. That is it for the European market open. Surveillance Early Edition is up next. Stay with us. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
We decided to raise the 3 key ECB interest rates by 50 basis points and approved the transmission protection instrument. All members of the Governing Council rallied to the consensus of 50 basis points. We expect inflation to remain undesirably high for some time, owing to continued pressure from energy and food prices and pipeline pressures in the pricing chain.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, and here's what's coming up on today's programme. We are all hawks now with a surprise hike. The ECB ends 8 years of negative rates. Christine Lagarde says surging inflation made it an easier call. Uncertainty in Rome. Italy will choose Mario Draghi's successor on September 25th as political uncertainty and economic concerns mount. And snapping the rally, Snapchat's parent misses on revenue, sending the shares plunging after hours and weighing on tech stocks and US futures today. There was some softer economic data out of the US. Then you had French and German manufacturing and services PMI. Now we have it for the Eurozone PMIs. Euro area, July manufacturing coming in, PMI 49.6, missing the forecasts. It is a pretty significant miss, 49.6. The forecasts have been for 51. Actually, I'm not going to say significant, modest miss, 49.6, forecast for 51. Euro area July services PMI, meanwhile, falling to 50.6, so a bigger miss there. Forecast were for 52. And the ECB's third quarter survey showing that Euro area inflation was at 2.2% in the longer term. We're going to get inflation data out of the Eurozone towards the end of next week. So again, it's a miss in terms of manufacturing and services across the Eurozone. That was already flagged by what we saw in Germany and France as well, and that pressured the euro. In terms of how the euro is playing out now, currently down 0.8% for the single currency. Of course, Christine Lagarde made a point of mentioning the currency and the euro as one of the reasons for that more aggressive rate hike of 50 basis points versus 25 yesterday in the press conference. In terms of the broader picture when it comes to European equities, you're seeing modest gains of about 0.1%. Technology is up despite the concerns about Snap in the US and that dwindling advertising revenue. We have some big tech names reporting next week in the US. The Bloomberg dollar index gaining 0.3%, so dollar is back again. That strength coming through, proving something of a risk-off, of course, sentiment when it comes to dollar strength. When it comes to Bitcoin, 23,117. So the gains being locked in for this week, at least for now, when it comes to that major cryptocurrency. Let's switch it on, see how things are playing out then. Across the map, we're looking at data as well that came out of the UK at around 7 a.m. UK time around retail sales coming in less badly than some expected. You're seeing gains of about 0.1%. Largely that's down to what's happening in energy. You're seeing higher oil prices, iron ore as well, and that's supporting the FTSE 100. The CAC going is range bound. You're seeing losses of 0.1% over in Germany. Italy is down by 0.2%. So the losses that we saw yesterday, of course, on that political risk, and still a little uncertainty around this tool, the anti-fragmentation TPI tool, and whether or not really it is ever going to be used in the case of Italy, the spreads and whether or not they continue to blow out. Last time I checked, about 236 over German bunds. Talking of which, the ECB, of course, doubling the expected size of its first rate hike in more than a decade, saying the economic data, and we're getting more of that today, will determine the size of future moves.
We expect inflation to remain undesirably high for some time, owing to continued pressure from energy and food prices and pipeline pressures in the pricing chain.
For more, we are joined by Bloomberg's Jana Randau then, who, of course, was monitoring all of this for us yesterday. Jana, why the last-minute change of heart then, and what does it mean for monetary policy of the ECB going forward?
Good morning. Yes, it was indeed a change of heart after policymakers flagged pretty much until the last minute that the rate hike was only going to be 25 basis points. But what made the decision easy in the end was indeed the inflation outlook, and what we've seen out of the ECB this morning. The survey of professional forecasters confirms that to an extent. Forecasters raised their long-term inflation expectations to 2.2%. It might not be much about the 2% target, but it is significant. And of course, right now inflation is running at 8.6% and rising, and that just had the ECB very concerned that and expectations for faster price growth is becoming entrenched in the Eurozone. What helped the decision as well was that policymakers were able to agree on this transmission protection instrument, which will make sure that there is no bond market disruption, no unwarranted moves in parts of the Eurozone as the ECB indeed raises interest rates. Forward guidance for the next months has been axed from the statement, if you want. So the ECB said it would decide meeting by meeting on further rate steps. We expect more to come, but how big they are going to be will depend on the data.
Okay, the size is going to depend on the data, and the data is coming in weak at this point. Jana, what do we know, though, about this new acronym, the TPI, whether or not it's actually going to be effective in terms of implementation, if indeed it ever comes to that?
Well, the president has been clear in saying the ECB will not hesitate to use the tool if it's necessary, but she also said that they prefer actually not to, and that, of course, is because there are legal concerns in Germany over the tool. Everybody agreed, so including the Bundesbank president. That doesn't mean that the tool won't be challenged, though. There are a few safeguards in there. For example, that the sound fiscal policies are an absolute must for the ECB to even consider purchasing bonds. And even then, that is not the only thing that the ECB wants to see and will take into account. Purchases will focus on public sector bonds, although they said private sector could also be considered if necessary. They're looking at maturities from 1 to 10 years, so slightly different from previous purchase programs, and they are accepting pari passu status on their purchases of public sector debt, which means should there ever be a debt restructuring, which of course is very, very unlikely, they accept to be treated in a similar way than other investors. But overall, they are hoping that the mere existence of such a tool will actually make sure that investors stay back, don't speculate, and will allow the ECB to keep this on the shelf.
Yeah, and some implicit messages for the next coalition government of Italy within the framing of that tool. Jana Randau, thank you. Of course, passing all of that detail for us throughout the last 24, 48 hours when it comes to the ECB and changes there from the European Central Bank. Joining me now is Deirdre Cooper, Portfolio Manager at 91. Deirdre, thanks for joining us in the studio. Happy Friday. What do you make of this shift in policy from the European Central Bank? And to what extent do we now have a little bit more clarity on central banks and how that informs your positioning?
Look, I think the ECB is in an incredibly difficult position in that it needs to tackle inflation, That's obviously become a lot more difficult post the Russian invasion.
Okay, we're having some technical details, Deirdre, with your microphone, so we'll get the team to check that for us. It sometimes happens. It's live TV. We'll get Deirdre back on. We'll get that microphone hooked up and her analysis as well and her takes. Let's check in on the markets as we try and get that technical issue resolved. We are seeing pressure on the euro. It's worth noting that in terms of the single currency. It's currently down 0.8%. We've had that Eurozone data in terms of PMI. You had the French and German data come in with a clear miss when it comes to manufacturing and services for the month of June. That adding to pressure on the euro. But you also have dollar strength as well. So the Bloomberg Dollar Index currently up 0.3%. Across these equities, very modest gains when it comes to European stocks, just 0.1%. You saw obviously a pretty significant sell-off in Italian equities yesterday, adjusting of course to the political changes in that country, but also the ramifications of this TPI tool. The FTSE MIB is now down 0.4%. When it comes to the US, another strong session, 3 straight days of gains in the US, but then the concern around economic data, those jobless claims, but also the factory output, little softening there when it comes to the US. And then you had the earnings of Snap, and after hours, that did weigh on the tech sector. The S&P E-mini is now looking at losses of 0.5%. It's slightly heavier in terms of the bloodletting across the tech space. NASDAQ futures points into losses of 0.8%. The context is that tech has seen something of a rebound in the US, but of course the concerns around advertising linked to Snap. Okay, coming up, talking of technology, stocks getting knocked down in extended trading, as I said, after that disappointment around sales, advertising sales from Snap. We're going to dig in to the tech sector next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think the Fed is raising rates quickly, which is the tool they have, and also telling people what they're doing and being transparent. And if you start to see some adjustments being made, the rate of increase in certain areas has tipped over a little bit, but there's still work to do. In the end of the day, the Fed's toughest job is the fact that it's trying to slow down an economy which has strong employment, strong wage growth, and strong spending. And that's not the usual. That's an unusual case to see all that go on at once. And by the way, with the U.S. being one of the strongest economies in the world, and so I think they've got a tough job ahead of them. But they're using the tools they have, which is to basically raise rates and change the balance sheet, but more importantly, to tell people what they're doing. And you're seeing the markets adjust to that.
Brian, you have so many ways at Bank of America of looking into the U.S. economy, getting a sense of where it really is. One of the big questions is, do we think inflation has peaked? If you were asked that question, what would you say?
Well, I think it'd be different for different areas. So you're seeing in some areas the rate of increase slow down and starting to tip over, but you're seeing other areas, wage growth is still very strong. So I don't think it's peaked yet. And our economists would say it's peaking probably is our team. Our team basically says that the Fed will continue to raise rates, and actually Candace Browning-Platin's team, the research team at Bank of America, has the year-end recession, which they made a call on a few weeks ago. But it's a slight recession, and a recession is not accompanied by high unemployment, which means it ought to right itself and come back out. But it's more the impact of the Fed raising rates and slowing economy. So it's peaking is probably more appropriate than peak.
Okay, inflation peaking, but not yet peaked. That is the view there of Bank of America CEO Brian Moynihan on US inflation. Now to technology, and Snapchat's parent Snap plummeting 27% after disappointing revenue raised concerns about the outlook for online advertising. Meta, Alphabet and Pinterest all sank on the news as well, as Snap sparks a second sector sell-off in 2 months. This after tech has actually performed fairly well in the last few days. Let's bring back in Deirdre Cooper then, portfolio manager at 91. Deirdre, let's get your take on the Snap earnings, but more broadly as well, what we're seeing in terms of multiple compression across the tech space, how much further there is to go, and whether there's any opportunities now, given what we've seen in terms of the compression in multiples.
So I think more broadly, we clearly saw a huge amount of multiple compression in Q1 of this year as people worried about inflation and rate increases. What we're seeing now, and I think Snap is a great example of that, is the other side, the E rather than the P in your multiple. And we're starting to see earnings revisions coming. We think we're going to see more of them. I think Snap's probably a leading indicator in terms of advertising revenues that are perhaps the early stage of the cut. Some of the others may well come later. So we're really looking for companies that have structural drivers, not cyclical. And we also really think that those structural drivers will be driven by some of the big sustainability trends that we're going to see over the next couple of years.
How do you fold that view into the broader tech space then? How much divergence do you expect to see? We have the social tech companies, and you're talking there about the potential further downside in terms of those downgrades, in terms of outlooks. Is there a case to be made that some of the other players within the tech space that focused on hardware or software, there's a bid there, there's an opportunity, and you can get exposure?
I think that's exactly right. So I think we're going to see huge divergence. There are parts of the tech space that have really strong structural drivers. I mean, things we look at are things like electrification, trends that is really moving forward. If traditional auto sales are down this year, electric car sales are up almost 100%, driven by not the US, not Europe, actually driven by China. So those are some of the structural trends we look for, and that means you're going to get a big bifurcation in performance.
How do tighter monetary conditions, we're starting to see that now from the ECB as well, joining the pack, change or adjust your views around some of these thematic themes? Does it make it more challenging?
Look, I think it actually helps the companies with structural, not cyclical drivers. As I said, we're moving towards a world where the cyclical looks really difficult. We've seen the challenges, we just talked about the challenges the ECB faced, trying to manage inflation caused by, to some extent, the war in Russia and Ukraine, really difficult politics in places like Italy. So you need to raise rates, but you also need to keep the periphery spreads in check. That's going to be a very choppy environment for European equity markets more broadly. Same in the US, interest rates are rising. It's going to be a difficult investment environment. So you need to find the structural, not cyclical drivers.
Okay, structural versus cyclical. What about when it comes to gas and this big dash for gas that we've had across Europe and trying to build out our own facilities, storage facilities? The Europeans even classifying gas as green. How much of a headwind is that for those structural things around decarbonisation? Does this throw that off track?
So in the short term, it will certainly throw emissions reduction off track. European emissions will go up this year. Europe will have to use more coal. In the long term, though, it absolutely accelerates the drive for decarbonisation. No one imports their wind or their sun, or to some extent their electric cars or their energy efficiency. So Europe is kind of realising that the gas bridge they were planning to use to decarbonise wasn't a particularly good idea, right? As I think one of the German energy ministers said, that bridge is broken. Perhaps that bridge should have never existed. You need to go all the way to a fully decarbonised economy. And then, of course, you're also a fully energy secure economy.
What are you hearing from investors and in terms of fund flows into those areas? Is there a reticence, at least in the short term? You talked about short term versus long term. Are you seeing that in terms of the money flows?
So we're really not, actually. Investors have been incredibly supportive through this sort of time of market turmoil. There certainly has been a bit of sort of backlash. Is our sustainability funds going to work in an environment that isn't a low interest rate environment? And I think, like all of these areas, you sort of separate the wheat from the chaff. The sustainable funds that were tech funds in disguise will clearly do less well. Those that were really looking for long-term structural drivers that are going to outweigh cyclical, those are areas that are still attracting inflows. But more broadly, flows into ESG and sustainable funds have fallen less than the rest of the market and continue to be strong.
You have an interesting call on China versus the US and Europe, and you have some preference there. Just unpack that for us. Make the case for China, given all of the concerns around geopolitics, around human rights abuses, particularly around the polysilicon and forced labor, all of those issues. How do you make the case for China at this point?
Look, the first point is no country, no company is perfect from a sustainability perspective. China, just broadly, from a fiscal and monetary policy perspective, is in a very, very different place to Europe and the US. We just talked about how challenging the environment is with rising interest rates, rising inflation. China's in a very different place. Monetary policy is getting looser. They're going to need fiscal stimulus. Zero COVID has been incredibly damaging to economic growth. The Chinese government just has an extraordinary number of levers at their discretion to help to offset that with stimulus. And we really believe that stimulus is going to be focused on those areas that are aligned with common prosperity, and environment is right at the top of the list. You can't keep doing property. You're going to have to do some of these other areas. To the sort of, to all your other points, I think those are issues that we really worry about, we're really concerned about, but not every company in China is involved in all of these areas, just like not every company in Europe is Wirecard. Not every company in the US is Enron.
So it's a question to follow the policy in China.
Absolutely.
Deirdre Cooper, thank you very much indeed. Co-head of thematic equities, of course, portfolio manager at 91. Okay, coming up, we will talk Twitter earnings ahead of their second quarter results later today during our tech wrap. That is later this hour. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
booked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Let's get the first word news now with Leanne Gerrans. Leanne.
Tom, good morning. Sources tell Bloomberg that the German government is in the final stage of a deal to bail out energy giant Uniper. The move is aimed at preventing the collapse of a linchpin in the country's energy network in the wake of Russia's move to slash gas supplies. The government is said to be looking for a stake of between 25 and 30% in a capital increase, with a price of €1.70 a share. Now, shelling by Russia has pounded a densely populated area in Ukraine's second largest city. Officials and witnesses in Kharkiv said at least 3 people were killed and about 24 others injured. The barrage hit a mosque, a medical facility and a shopping area. Police said cluster bombs hit a market. Italy will hold an early election on the 25th of September after Mario Draghi resigned as the Prime Minister. President Sergio Mattarella officially called the vote after dissolving Parliament. Polls suggest a centre-right coalition led by the Brothers of Italy could have a clear majority, but the euro area's third biggest economy now faces months of political uncertainty. Applications for US state unemployment insurance rose for a third week to the highest since November. A growing number of companies have announced job cuts, suggesting some softening in the labour market. Data showed initial unemployment claims increased by 7,000 to 251,000 in the week ending July the 16th, higher than analysts forecast. And right here in the UK, the latest polling shows Foreign Secretary Liz Truss has extended her lead over the former Chancellor Rishi Sunak in the race to be the country's next Prime Minister. A YouGov survey of 730 Conservative Party members gave Truss a commanding 24-point advantage over her rival. Sunak has won all 5 rounds of voting among Tory MPs. Now the party's wider grassroots membership will choose between him and Truss, and the winner will be announced on the 5th of September. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Leanne, thank you. Okay, coming up, Norsk Hydro will return as much as 5 billion kroner to shareholders. We'll speak to the CFO. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We are all hawks now. With a surprise hike, the ECB ends 8 years of negative rates. Christine Lagarde says surging inflation made it an easy call. Uncertainty in Rome. Italy will choose Mario Draghi's successor on September the 25th as political uncertainty and economic concerns mount. Snapping the rally, Snapchat's parent misses on revenue, sending the shares plunging after hours and weighing on Asia tech stocks and US futures today. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Now to the earnings story. An aluminium maker, Norsk Hydro, will return as much as 5 billion kroner to shareholders. That's after reporting a record profit from its primary metal and extrusion business. Joining me now is the company's CFO, Pal Kildermo. Pal, congratulations on the results. You're returning money to shareholders, dividends and buybacks. Is this peak profitability for the company?
Well, it's the fifth consecutive record quarter we have as Norsk Hydro. And when you look at the outlook into the coming quarter, it does look somewhat more uncertain. Aluminium prices have come down from the highest levels on record, I guess, since 1987, fell by more than $1,000 in the quarter. And we've also seen that alumina prices have traded somewhat down, whereas raw material costs are still holding somewhat up. Where we are benefiting a lot as a company is on the energy side, where markets are tight. But adding that all together should result in a lower Q3 than the second quarter.
Okay, well, there's a lot to go through there. Let's start with the demand picture then, Pal, if we can. Are you starting to see softness in Europe, and if so, which sectors?
We are. And when you look at our full year demand estimates, then it has come somewhat down. We were earlier expecting an undersupply for primary aluminium for the year as a whole. Now it's more balanced. And the sectors where demand has been stronger than expected is on the building and construction side, but where there's been weaker than expected has been on the automotive side. Supply chain issues and the continued time to get chips, etc., has still impacted Q2. But if you look into Q3, then that situation is reversing somewhat. There we see building and construction pulling somewhat back, whereas automotive is hopefully, and as it looks, gaining momentum, which benefits a company like ourselves that is automotive exposed. And another area where demand is very strong these days is still for greener aluminium. We increased our sales 89% quarter over quarter for green aluminium.
Okay, so very strong demand for green aluminium. An interesting breakdown there of the different sectors and how that demand picture is shaping up. When it comes to energy then, Val, you touched on this. Just how bad do you think it can get? I mean, obviously smelters are major pullers in terms of major consumers, major users of electricity and energy. How bad does it get in the winter?
That's a very good question. And that is what could really balance what we're seeing on the demand side when you're looking at Europe as a whole. So far this year, or this year and last year, around 900,000 tons of smelter capacity has been taken out due to the very high energy prices in Europe, but also some in the US. We still see around 1 million tons at the risk of having to curtail as their existing power contracts or hedges expire in the coming period. So that is huge for the European aluminium industry, which has become smaller and smaller over the years. For Norway and for potentially Iceland also, where there is also a lot of aluminium production capacity, there are more long-term power contracts at the attractive price, which should be able to maintain the production there.
And you've done some hedging around pricing. What is your view, given everything that you've just talked about in terms of demand and supply, the input costs, in terms of where pricing ends up towards the end of the year? Do you see further softening of pricing at this point?
That's a very good question. And at the end of the day, we don't really know. And that's why we have also hedged a quarter of our portfolio. I would be happy for us to lose money on those hedges, because that means that we make money on the rest of the portfolio. But in uncertain markets, having something extra on the downside is usually worth more than having something less on the upside. There are two things moving against each other. It's the demand on one side. If demand continues to weaken, as it looks is happening now, then all else equal, the price typically trends down. But the issue with the price now is that you're pricing well into the cost curve. You're now pricing at the 65th percentile of the cost curve, which means that 35% of smelters are loss-making. So it depends on how long time it takes for those type of smelters to curtail production before you get prices moving back up again. Because energy prices and input factors are still high.
They are still high, Pal. Do you have any sense, any clarity, the data that you're seeing around when you think those input prices start to moderate?
Yeah, if you look at our two biggest business areas with this bauxite and alumina and aluminium metal, then our guidance on the cost into the next quarter is quite limited compared to what you've seen from Q4 to Q1 to Q1 to Q2. We're actually guiding for somewhat lower input cost in aluminium metal, primarily driven by falling alumina prices. So if not falling, we have seen some flattening on most of the raw material prices. And then we will see through Q3 how that further develops. But they are also exposed to many of the same demand drivers that we now see impacting the aluminium market negatively.
And Pal, before we let you go, you have a plant in Slovakia. You've been cutting production there. Ultimately, were you looking at a potential closure next year of that plant?
Well, if you look at Slovakia, the power market, with the prices that you're seeing now and the LME prices, that would be running at a large cash loss into 2023. So if we don't get anything on the regulatory side, or if power prices don't fall or LME prices don't increase, then it looks challenging for 2023 for Slovakia.
Okay, Norsk Hydro CFO Pal Kildermo, thank you very much on those results that beat and a return to shareholders in terms of buybacks and increase in the dividend. Thank you for your take. Okay, let's recap some data then coming through. We had the Eurozone data in terms of PMI, France and Germany as well. Here now we have the UK July manufacturing PMI coming in, and it's a beat for the UK, 52.2. The forecast was for 52. Services PMI, meanwhile, falling to 53.3. Still, of course, comfortably in expansionary territory. The forecast had been for 53. So the data out of the UK diverging with what we're seeing in the Eurozone, and it's a beat there for the UK when it comes to manufacturing and services PMI. Also, a line crossing on Uniper. The German Chancellor, Olaf Scholz, will speak on the question of Uniper and that bailout, of course, that we know has been worked up in Berlin at noon in Berlin. So we'll bring you the details of that, of course, as we await what will happen in terms of that response from Berlin, in terms of the bailout of course, that major utility company with the gas flows out of Russia, part of the mix there. Coming up, UK retail sales fell less than expected in June as food spending jumps the Jubilee boost. We look at the economic picture of the UK next. This is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Now, soaring food and fuel prices and rising interest rates have kept UK consumer confidence at a 48-year low, according to the latest monthly research by GfK. Almost all of the measure that make up the confidence index all of the measures remain in deep negative territory. Bloomberg's Lizzie Burden has been looking at the details, and of course we also had the manufacturing and services PMI as well. Let's start with retail sales, Lizzie, and your take on what's been happening there.
Yeah, it's slightly better than expected, but it's a slight drop from the previous month. And so what it reflects is the cost of living crisis weighing on people. As you saw from that GfK survey that you mentioned, people are severely depressed, says GfK, about their outlook. But at the same time, we aren't at peak inflation yet, and you had that boost from the Jubilee bank holiday on food sales offsetting the rest. What it means for the BOE, I don't think it moves the dial really. We've already had the inflation jobs data this week, and you've seen from the ECB a 50 basis point hike, so it looks like the Bank of England will do the same. You mentioned about the PMIs. It seems a little out of step again with that GfK survey, but don't forget the PMI doesn't cover all the industries, so this is actually what our economists were expecting.
Yeah, so a beat there. I mean, just broadly, in terms of the data today out of the UK, it's been a beat in terms of retail sales, less bad than expected, manufacturing and services coming in better than expected on PMI, but of course, where there's important caveats, and as you say, it probably doesn't change the calculus of the Bank of England. What about the politics of the UK, where things stand in terms of Rishi Sunak versus Liz Truss?
Well, as expected, Liz Truss is in the lead because now it's the grassroots members who are voting. In the latest YouGov poll, she's 24 points ahead. The debate's still very much focusing on the economics of it all. They're trying to outdo each other on who is the heir to Margaret Thatcher. Aside from that, well, I mean, investors really are concerned about Liz Truss's stance, not just on the Bank of England, but also on Brexit and tax cuts, I'd say in that order. But really, I think in the TV debates that are going to come up, there are two to come, it will focus on character and competence. And I have to say, every economist I've ever spoken to at the Treasury who briefed Rishi Sunak when he was Chancellor says that he knew the detail before they even told him.
Very interesting. So watching for those debates. I think the first one, correct me if I'm wrong, is on Monday evening. So watching that and see if he can move the dial. Rishi Sunak, he is lagging in the polls.
He's got a lot of ground to catch up.
He's got a lot of ground to catch up. Lizzie Burden, thank you, of course, on the economic data and the politics, of course, of the UK. Now we are joined by Penny Hughes, chair of Riverstone. It's a later living property developer backed by Goldman Sachs. Penny has served on the boards of several leading consumer brands, including The Body Shop, Vodafone, Morrison's, and most notably Coca-Cola as well. In 2020, she oversaw the sale of IQ student accommodation to Blackstone for more than £4.5 billion, which I believe is the biggest deal of its time. Penny, thank you for coming into the studio. Quite the portfolio, quite the CV you have there, the resume. Let's start with Riverstone then, which is kind of the primary focus of your energies at the moment. What are the expectations around the opportunities for this later life accommodation? It's something that we see predominantly in, I'm thinking of Florida in the US, but also Australia. Can it work here? Is it working? And where are you looking to expand?
Oh, right. That's right, Tom. Well done. So in New Zealand, in Australia, more than 5% of the over 65s will live in some kind of retirement community. In the UK, it's less than a tenth of that. And yet we know that the over 65s is the highest growth population. So we're expecting over 75s to double in the next 30 years. And really, we have very little appropriate housing options for them. And so this is an emerging asset class. Riverstone is focused in London. There are other companies focused outside of London too. And really, it is an amazing opportunity to provide the right sort of housing options for later living.
Okay, so that's the demand. What are the challenges in this space, whether it's finding the property, getting the funding, and indeed labour costs as well, the staffing?
Yes, there are some challenges. One of the challenges is actually in planning. So only 1 in 4 boroughs have actually allocated a quota for later living new housing. And so that's one of the things that we would be talking to government about in terms of improving the planning sort of framework for these developments. At Riverstone, we've just opened in Kensington. We're due to open in Fulham later this year. We have a site in Hampstead and an intention to roll out to 10 properties in London. And so we're a property developer, but obviously we're also an operator. So yes, hiring people in London, is challenging. But if you've got something new like we have and something really quite special, then we've attracted some really super talent.
Has Brexit made it more difficult? Have you had to raise wages more than maybe you would have expected?
There are wage increases, and I see that across my portfolio. And obviously, COVID in particular was difficult for this sector because this was a community that was particularly impacted by COVID. So now we're largely through COVID. That is, and I think what COVID has probably demonstrated to us that being part of a community and having a set of services on site actually helped the healthcare of this older population. And so I think COVID has probably meant that the later living opportunity is even greater than it was before. So we're very optimistic. Obviously, we've opened Kensington. We've started selling. We've started having residents come into the property. There are beautiful services on site. There's leisure facilities. There's healthcare facilities. And so it is a very attractive proposition.
I want to get your views on what's happening with the politics of the UK. We had SoftBank and Arm. We were hoping, of course, this capital markets, you're not inexperienced when it comes to the capital markets as well. We were hoping, of course, the UK was hoping to attract Arm to list in the UK, in London. It looks like that may not happen now, and SoftBank flagged the political risk. Are you seeing that bubble through now amongst the business people that you're talking to when it comes to that commitment to invest in the UK?
So at Riverstone, and indeed other later living, there has been a significant interest in the sector because it is an emerging asset class. You mentioned earlier that I was chair of IQSA student accommodation. This really is the next platform property asset after student accommodation. And so there has been significant inflow of capital, and it has to be long-term patient capital because these are properties that take, a few years to build and a few years to sell, and therefore a few years to see true value from. But if you're asking me, are the equity and debt markets difficult right now, then the answer is absolutely yes. But obviously at Riverstone, we're backed by Goldman Sachs, and therefore we're able to continue with the business
So I'm asking you to step away from Riverstone,
Yes.
drawing on all of the experience that you have and getting a sense as whether UK Inc. is becoming less attractive now because of the politics and the uncertainty.
Uncertainty is never good for business. And so the sooner that we can have certainty, the better. Obviously, the economic backdrop is difficult. Cost of living crisis will make it difficult for consumer businesses. But that's when leadership is needed.
Are you preparing and bracing for a recession here in the UK?
I think we will find that there is a slowdown. But again, with my Riverstone hat on, that's not impacting. But with some of the other things that I do, I can see something of a slowdown. But it is up to business leaders as well as political leaders to continue to really adapt and be agile to the circumstances that you find yourself in. And so I'm careful, but still optimistic.
Careful, but still optimistic. We'll leave it on that note. Thank you very much indeed for coming to the studio this Friday. Penny Hughes, of course, chair of Riverstone. Okay, let's get your Bloomberg Business Flash now with Leanne Gerrans. Leanne.
Hi, Tom. Sources tell Bloomberg that the German government is in the final stage of a deal to bail out energy giant Uniper. The move is aimed at preventing the collapse of a linchpin in the country's energy network in the wake of Russia's moves to slash gas supplies. The government is said to be looking for a stake of between 25 and 30% in a capital increase, with a nominal price of €1.70 per share. One of Elon Musk's top lieutenants is said to be under internal investigation for his role in a plan to purchase hard-to-get construction materials. Ahmed Afshar is the executive running Tesla's Texas factory. Sources have told Bloomberg that Tesla plans to be part ways with Afshar, but terms of his exit are still being worked out. Some employees have already been fired over that investigation. Amazon is starting the delivery of packages to US customers using the first of many 100,000 electric vans built by Rivian. Amazon expects to have the vehicles deployed across more than 100 cities by the end of the year. Amazon has delivered 430,000 packages using Rivian pre-production vans since 2021. Speaking on Bloomberg TV, the company's CEO confirmed plans to cut 5% on the non-manufacturing roles.
These are some of the hardest decisions, a leader has to take in running a business, and certainly we're trying to be as intentional and as thoughtful in terms of what that means for the business, what that means for the individuals as we work through that process. But as you said, this doesn't impact our manufacturing teams. This is really more heavily in some other aspects of the business.
And Mattel, who makes Barbies, says second quarter margins declined due to inflation, higher supply chain costs and royalty expenses. Gross margins shrunk to 44.4% from 47.5% just a year earlier. However, profit and sales were a beat, driven by demand for action figures. The CEO says he still expects growth in the second half and also next year. And that's your Bloomberg Business Flash. Tom, I was told boys' toys, not just Barbies.
Boys' toys, not just Barbies. We try and keep Barbies out of our house with our daughter, but it doesn't work. She just loves those, loves the dresses and the dolls, and taking heads off and stuff like that. Maybe that points to my daughter's dark intentions. Anyway, moving on. Coming up, technology stocks get knocked down in extended trading after Snap's sales disappoint. Tech in focus next. This is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Now, Snapchat's parent, Snap, plummeted 27% after disappointing revenue raised concerns about the outlook for online advertising. Meta, Alphabet and Pinterest also sank on the news as Snap sparks a second sector sell-off in just 2 months. Joining us now is Alex Webb from Bloomberg Quick Take. Alex, what do the Snap results mean for the broader tech sector?
Well, we've been talking for a while about how the first companies that get hit in an economic downturn are often the ones exposed to marketing, and because that's the first thing that companies cut. They cut their marketing and advertising budgets. Now, that clearly has implications for Google, Alphabet, Meta, and Facebook, and slightly further down the pile are, of course, Twitter, Snap, Pinterest, and these others. The thing is, with Snap, it was trading, certainly before these earnings, at an incredibly punchy multiple, 145 times forward earnings. That doesn't leave much wiggle room for error. And so if it shows any flaws, which it clearly did, particularly in the current quarter, where it says revenue is about flat with the year earlier. So it's not showing the growth on which it's valued. It's valued as a growth stock. That's why it's being punished.
Okay, remarkable PE, despite the drawdown that we've seen. Looking ahead to Twitter, what are you looking for?
Any comment on the Musk situation will be interesting. It seems highly unlikely they will say much because there is this court case, and they'll probably use that as some sort of cover for not doing anything. But also, what impact genuinely has the Musk situation had on its business? Or is that actually just structural? They're structural issues that they haven't worked on. I.e., is there a solution coming down the pipe, coming out of the Musk situation, which will let them continue to grow apace? Or are there broader issues which haven't been dealt with?
And of course, if they win that court case, and that's a big if, they get about $1 billion from Elon Musk.
No, they will get $1 billion either way. The $1 billion is the breakup fee. If they get a settlement of maybe 5, 8, some have even said $10 billion, and that if they were to get $8 billion, that would be 4 times the cumulative free cash flow in their history as a public company.
Very interesting. Looking ahead to Twitter earnings, Alex Webb from Bloomberg Quick Take, of course, breaking down what to watch for within tech. Now, Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller and Kelly Lyons in New York, and of course, Anne Edwards here in London. Your markets here in Europe gaining 0.4%. Future stateside looking to losses of 0.3 on the S&P E-minis. Nasdaq futures currently down 0.6%. The euro under pressure after some weaker than expected data, down 0.7% at 101. Stay with us. This is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
When are you ever going to see growth in inflation higher than it is right now?
That's the inflation picture in Europe and globally. It just forces central banks to front load.
We put a 50-50 chance of recession. Most of the clients I speak to think that it's much higher than that.
We're positioned for, as we say, a little R recession.
The recessionary talk, the doom and gloom scenarios are becoming a bit more consensus.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Social media giants get hammered. They lose almost $47 billion in market value after disappointing revenues at Snapchat's parent raises concerns about online advertising. Central banks are hiking fast to make up for lost time. Does the speed of tightening make recession the price to pay for beating inflation? We will have analysis. And Joe Biden becomes a symbol of the fight against COVID. The president is being isolated after testing positive and experiencing mild symptoms. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines over in New York. Kaylee and Matt, good morning to you from London. And Kaylee, we seem to be separated by the Atlantic in terms of stock market performance today. We don't have such heavy weighting to tech here in Europe, which perhaps on this occasion helps.
Yeah, absolutely, and it'll definitely be an influencing factor next week when we have all of the mega caps reporting. Certainly Snap not sending a great signal for the likes of Meta and Alphabet, and we'll have more on that in just a moment. I do want to quickly run through what we saw in Asia overnight, because honestly in equities it was a relatively muted session, just very small gains across most of the major benchmarks. The MSCI Asia Pacific Index up by about 0.2%. Where the more dramatic action is today is really in the bond market. That is a story globally. Yields coming in as economic data is disappointing. First, you had jobless claims, the Philly Fed Index in the U.S. Then you had those PMIs out of Europe today. So yields are moving lower across the board. And that was definitely true in Australia and New Zealand. The 10-year Aussie yield down 13 basis points. The 5-year in New Zealand down about 9 basis points overnight. And finally, I would just note that we did get inflation data out of Japan, 2.2% on consumer prices in the month of June. That, of course, is above the BOJ's target of 2%. And yet Kuroda says he has no intention of hiking anytime soon. So that is keeping continued pressure on the yen, which right now is trading at 137.55 to the dollar. But of course, literally everything in G10 is weaker against the U.S. dollar this morning, Matt.
All right, let's take a look at what's going on here in the U.S. S&P futures down a little bit. Of course, that Snap news that Kaylee's already spoken about is going to weigh heavily on U.S. markets because of the tech weighting that Anna was talking about. We also have investors buying 10-year debt. That pushes the yield down now 6 basis points, so a pretty big drop to 281.42. It's been a while since we've seen it down at this level. And NYMEX crude not doing a lot. So in terms of commodities, crude is not it. But after we look at Bitcoin, $23,305. I want to highlight a couple of commodities that Anna brought to my attention. Wheat and corn trading on the CBT, both coming down pretty substantially, and the volume is huge. I'm talking about 50, 60, 70% more than we normally see at this time. That's because we're expecting to see an agreement signed today that will allow the Ukraine to resume its shipments of grains through the Black Sea. So, Anna, that should put some more downward pressure on these prices.
Yeah, we saw that starting last night, didn't we, in the US session, carrying on now. Will we get any material commitment in that regard, Matt, I suppose is the question, and how about the demining efforts that would involve? A lot of questions, but really worth keeping an eye on those commodities with that conversation taking place in Turkey today. Here on the European equity markets, we're actually losing a little bit of steam. So as I started the program saying we were moving in different directions across the Atlantic, well, not so much now. European stocks fading just a little. Certainly the UK market now pretty flat. We have very modest gains coming through in France and in Germany. It seems we're buying stocks and we're also buying bonds today. Let me show you what's going on with FX markets as well, because we've had a lot of data out from Europe earlier on. Kaylee referenced this, and this certainly has added to weakness in the euro. So the euro down by 0.7%, a day after we got that big hike, and further details about the transmission tool from the ECB. A day after that, we then are reminded of the growth threats ahead. We got French manufacturing PMI, which is now in contraction, German manufacturing and also services PMI, both in contraction. So really headlining the threats to the Eurozone economy still to come. The pound, it seemed that some in the market were downgrading their expectations for how much of a hike we'll get from the Bank of England earlier on this morning, and that led to some weakness in the pound. We've paired those losses a little bit on the PMI data out of the UK, actually coming in a little bit better than expected and in growth territory. I put in the German 5-year yield in this case. We've seen a lot of buying, as I said, in sovereign debt as a result of the nervousness around the data, and that is reflected there in the German 5-year. And Uniper, also one to watch then, Kaylee, as we go through the session, up by 5.7% today. It's down, though, by 76% or so year to date. This gas business over in Germany in talks with the government, and we're expecting to hear from Olaf Scholz in around an hour's time, more details of what they intend.
All right, so that is definitely something we'll be looking forward to later this morning, and there is plenty more ahead today, including at 6:30 a.m. New York time, the rate decision out of Russia. We're expecting them to ease again, but this time economists only expect easing by about 50 basis points. Then tech earnings will continue with Twitter reporting at 8 a.m. New York time. In addition to the drama around its deal with Elon Musk, how much does it fall victim to those same advertising headwinds as Snap did? And finally, we'll get U.S. PMI data, the preliminary read for July at 9:45 a.m. New York time. Of course, Europe not setting a great tone with their data ahead of those numbers, Matt.
All right, we'll definitely be watching for all of that today. Let's get back to the Snap story. Plummeting after disappointing revenue raised concerns about online advertising. Meta, Alphabet, and Twitter all falling on the news. It's the second time in 2 months that Snap sparked a major tech sell-off, and to me it seems like it's just the disappointments from this company that remind me it still exists. Bloomberg's Alex Webb joins us for more. Alex, why does Snapchat have such a big influence on real markets?
I feel this is going to come across like a dig at you, Matt. I don't mean it to be, but it's because their audience and their user base is young. And of course, those are the people that the advertisers want to tackle. That's the really valuable demographic, your sort of 18 to 25-year-olds. And so if you are seeing a tampering back in the spending on advertising for that core demo, then the implications for the older demos is even more potentially drastic. Of course, Snap is smaller, less resilient perhaps than Facebook and Google, which in some ways, if you're in the market for almost any consumer product, you've got to be advertising on those platforms. But because Snap, of course, trades at a huge multiple, certainly before these earnings, 145 times forward earnings, it means that any wrinkle in the numbers is going to be punished, and this is what's happened here.
Okay, so there's the wrinkle, perhaps coming in the shape of TikTok competition as well, something that some are talking about. Let me ask you about Twitter and what we expect to see there. Again, we could see competition, but also internal distraction because of all that has been going on with Twitter.
Yeah, so if you have two problems at Snapchat, namely the Apple crackdown on online advertising and the economic environment, at Twitter, you have a third factor, which is the Musk factor, and whether it has been actually in some sort of stasis over the past 6 months or so, 5 months or so, because of that. Now, if they are trying to say, well, we've not been able to do as much because of this, then we probably need to see a plan for how they come out of it. What are the big strategic steps they're going to be taking to start delivering the pace of growth that investors are expecting? We've seen their valuation obviously come down significantly in the past few weeks. They were valued at 50 times forward earnings, then they're valued at 32 times forward earnings. They're a long way short of that $54 a share that Elon Musk offered. Is there a path to get back to it? That's what investors want to hear.
All right, Bloomberg's Alex Webb, thank you so much for your insight on all things tech. Now, after underestimating the worst inflation outbreak in decades, central banks are now driving their economies toward recession in order to tame prices. The stark outlook is stoking fears that policymakers will end up overreaching as they push ahead with aggressive interest rate hikes. And on that note, we're just getting some headlines out of the ECB's Peter Casimir saying that the September rate hike may be 25 basis points or 50 basis points. Of course, the ECB hiked 50 yesterday, brought rates to zero, ending 8 years of negative rates. He went on to say that data convinced him to start hiking with a bang, and the ECB move is beginning a series of similar steps. But you have to put that in contrast with the really weak PMI data we got out overnight or this morning from Europe, as Anna was detailing. Enda Curran, our chief Asia economics correspondent, joins us now. So Enda, this morning, a perfect example of the weakness that not just the ECB, but really central banks across the board are hiking into.
Yeah, right across the world. So the pace of these emergency rate hikes, Kaylee, are now starting to unsettle investors. They're saying the path to a soft landing really is getting very narrow indeed. We had a Bank of America investor survey this week pointing out that investor confidence in policymakers pulling off a soft landing has collapsed. We have predictions of a global recession in and around 50-odd%. And like you mentioned, we're getting gauges on activity right around the world, be it Europe, be it Japan, be it China, and of course parts of the US that show a slowdown is underway. And the feeling is now that perhaps after missing the inflation build-up, central banks are going too hard. We saw what the ECB did yesterday. Same for the South African Central Bank. We're going into the Fed, going by 75 basis points next week. When you put it all together, investors are concerned that by the end of the year, they may have done a lot of damage to growth.
Is it going to hit harder in some places than others, Enda? I mean, clearly it is. Do we know where it's going to hit harder?
We're already seeing it surface in places like New Zealand, for example. Matt, there's a big hit to house prices underway there. I think it will show up in those economies that have been moving fastest and most aggressive early on. People are keeping an eye on Canada, for example, and of course there's recession talk in Europe. But I think the big question is about just the extent and the pace of these interest rate hikes. I don't think anybody's arguing that central banks don't have to respond now, but you are even getting officials like Esther George from the Kansas Fed recently saying, look, the pace needs to be kept an eye on because we don't quite know where all of this is going to wash up. So as I say, this story has been brought into sharp relief by the ECB's move yesterday. We're heading to the Fed next week with that 75 basis point move. It's all of it combined is only stoking talk of a global recession.
All right, Bloomberg's Enda Curran in Hong Kong, thank you so much. Now let's head over to Washington. The White House is confident that President Biden will avoid the worst of COVID-19 after he tested positive yesterday, thanks to vaccines and a therapeutic drug. The president is experiencing mild symptoms and has begun taking Pfizer's Paxlovid. Joe Matthew, Bloomberg Washington correspondent, joins us now in D.C. for more. So, Joe, obviously we're in a very different moment now than we were when President Trump tested positive for COVID back in October of 2020. Do we have any update on the president's condition this morning?
Only that he's isolating inside the White House residence, and the White House was deliberate yesterday, Kaylee, to remind us that he was working. They kicked out an image of him, a photograph of him behind the desk. He also issued a video that he recorded on the balcony overlooking the South Lawn, and he looked healthy, said that he was feeling okay, and said keep the faith, all the stuff that you need to do to reassure the world as the president of the United States that things are continuing. But I'll tell you, there's a massive process underway right now at the White House to try to find close contacts with the president, remembering that he just did quite a bit of traveling. This is something a lot of people can relate with. It was 4 or 5 days on the road to the Middle East, Israel, Saudi Arabia. Then he came back to the U.S. and went to Massachusetts for an event just a couple of days ago. That's a lot of people and a lot of places that the White House will need to follow up with here. In the meantime, the messaging has been remarkable. Remembering it was 2 4th of Julys ago that the president said this country was close to declaring its independence from COVID. Yesterday, in the White House briefing room, Karine Jean-Pierre, the press secretary, said, we knew that this would happen eventually, which is not something we'd heard from the White House before. And they also said that everyone at some point should expect to get COVID. That is a very different message than we heard from this administration when the president was first elected.
All right, very interesting stuff. Going from the current president to the previous one, Trump insiders told the January 6th committee the former president ignored pleas to call off the mob storming the U.S. Capitol. The panel held a televised primetime hearing again last night. Republican Representative Adam Kinzinger, a member of the committee, spoke.
President Trump did not fail to act during the 187 minutes between leaving the ellipse and telling the mob to go home. He chose not to act. All right, so clearly he's in the minority in terms of people in his party that are critical of the president, but what do we expect to happen out of all this?
It's a great question. Look, we thought, Matt, that would be the finale last night, and the committee has now said that because much more evidence and many more witnesses are coming forward, I think Benny Thompson referred to it as the dam finally breaking, they're now allowing for further hearings. That's going to mean a delayed final report, so we'll probably have an interim report at some point, but it's unclear exactly what happens, Matt, if Republicans take control of the House, as many expect and are predicting in November. If the work is not done by then, the Republican majority could simply dissolve this committee and then turn around and investigate them, which is what a lot of people expect to happen. The fact of the matter is, though, we did get a TikTok last night. The President of the United States did spend that 187 minutes, for the most part, in the dining room off of the Oval Office watching all of this on TV.
All right, Bloomberg's Joe Matthew, thank you for joining us on TV this morning. And of course, you can also listen to Joe on radio every weekday on his program Sound On. That's at 5 p.m. Eastern on Bloomberg Radio. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. A lot of them related to earnings, or really most all of them. Mattel is one of them. It actually beat on profit, but its margins narrowed in the second quarter due to inflationary pressures and supply chain issues. And the company's CEO even saying they're starting to see demand waning for more expensive products like the Barbie Dream House, which I'm sure Matt's daughter is going to be begging for in a couple of years. It's about $200. People might not be willing to shell out that much for toys. That stock down about 1.5%. It's an even bigger move lower for Seagate, the biggest maker of computer hard drives. It missed expectations, citing big macroeconomic headwinds. It's down 11%, and it's a similar move for Intuitive Surgical. Really rare miss on both the top and bottom line. Actually, the revenue miss was the biggest on a percentage basis, going all the way back to 2013. That stock is down almost 12%, in fact, in early hours, Anna.
Good to see, with all that changes, that the Dream House is not one of those things, Kaylee. Right, we will come back and have a conversation about these markets. Ben Emers joins us, Managing Director at Medley Global Advisors. We'll certainly dedicate part of the conversation to the weakening data picture in the US yesterday and in Europe today, and Snap's slumping sales sparking another tech sell-off. We will discuss all of that with Rob Niaz, Hoxton Ventures founding partner and a former Google product manager. What does Snap tell us about the rest of the ad spend universe in the US? Plus, the sinking gold town, how one town in Ecuador is being consumed by sinkholes caused by illegal mining. Read more of today's Big Take story on Bloomberg.com or by typing NI Big Take into your Bloomberg terminal. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. Now, we had seen the S&P rally back to basically 4,000 from less than 3,800 this week. Kriti Gupta joins us right now to talk about how Snap is going to break that rally.
Snap the rally.
It's gonna. I didn't want to say that. But
You
yes.
got to go with the fun.
So, Kriti, and we saw a lot of breadth also a couple of days ago. We hadn't seen that. We didn't see that yesterday again. But what does this rally look like to you?
Well, we saw it earlier in the session where you did have, I think, every sector except, I want to say, utilities and energy that were in the red. So it is still a fairly broad rally. So not all 11 sectors in the green, but it is there. I think what's interesting here is that, yes, we've snapped the rally. We're going to giggle every time I hear that now today. But futures are down only 0.2%. This isn't a market that's panicking necessarily on headlines that I think are fairly panic-worthy, which is interesting. You had the same hiring story come out of Snapchat, guidance suspended in their third quarter. This is a lot to digest at a time when their daily monthly users are actually higher and beat estimates. So their fundamentals that they're usually judged by are strong, but then they're talking about this macroeconomic kind of headwind, and that's where you start to get the fears going into the tech space. But even with that, futures only down 0.2%. So
okay, so maybe you're not seeing stocks in pure panic mode, but it seems like bond investors are starting to panic about the economy a little bit because we've had a series of disappointing data points, both in the U.S. and in Europe this morning, and there's a massive rally coming in the bond market.
Oh, massive. And I think this is huge. It's getting very far away from that 3% level. It's kind of been hovering around for the last couple of days. And I think this is crucial because this is coming off of the PMI data that we got out of Germany specifically this morning. The UK PMIs, though, coming in still strong. They're still in expansionary territory, so that is good news. But to your point, Kaylee, you are starting to see that dip into, or dip in yields, I should say, hopping back into the bond market. I think what's interesting here is that you are starting to see it happen in the U.S. market as well, but it's not necessarily a U.S. recessionary story. In fact, I think it's more, obviously, it's going to be a European story, but we've been talking about that for a while. A couple months ago, we were talking about how European recession is almost a foregone case. The idea it's going to come and it might actually be isolated to the continent. And I think what's different this time around is that there is that contagion effect. And that's, I think, where you're seeing the relationship between what's happening in the bonds market, for example, to the U.S. Treasury market.
Yeah, and it's interesting, Kriti, that negative data, as Kaylee points out, led to selling of the euro, led to investors piling into government debt, but also buying stocks more enthusiastically, as if there is perhaps the start of that bad news is good news thought process that you get when investors start to think about whether central banks might pause their hiking cycle, as mad as that sounds, given they only just started yesterday.
Well, dare I say that there is no alternative might actually come back, the whole entire TINA concept, or even the Fed put, for example. I mean, if you're starting to price in rate cuts, you're starting to price in this idea that the Federal Reserve might not be as hawkish in going into 2023 as they are right now. That is a reason to buy. And I think to your point on currencies, look, you're hiking and the euro is not appreciating. That signals that there's a problem there.
Yeah, the euro down 0.7% this morning. Kriti, thanks very much. Bloomberg's Kriti Gupta. And for more market analysis, check out MLIV Go on your Bloomberg terminal. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now, keeping you up to date with news from around the world, here's the first word. In the UK, a new poll shows Foreign Secretary Liz Truss extending her lead over former Chancellor Rishi Sunak in the race to be the next Prime Minister. According to a YouGov survey of Conservative Party members, 62% said they would vote for Truss and 38% went for Sunak. An earlier poll this week had Truss leading by 19 points. Turkey says an agreement to allow shipments of Ukraine's grain will be signed in Istanbul today. Ukraine, Russia, and the UN will sign the accord. Ukraine's grain shipments have been largely stalled as its ports have been blocked since the Russian invasion. That's led to predictions of an increase in world hunger. And one of Elon Musk's top executives at Tesla is the subject of an internal investigation. Bloomberg's learned that Omid Afshar, who runs the company's Texas factory, is being looked at for his role in a plan to buy hard-to-get construction materials. Tesla has already fired some employees in connection with the matter. The terms of Afshar's departure are still being worked out. Coming up, we'll get back to the markets as we see a big rally in bonds off the back of disappointing economic data. Ben Emmons, managing director at Medley Global Advisors, joins us to give us his take on the global economy and the central banks of the world responding. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Social media giants get hammered. They lose almost $47 billion in market value after disappointing revenues at Snapchat's parent raised concerns about online advertising. Snap sees a major slowdown in the ad industry. Central banks are hiking fast to make up for lost time. Does the speed of tightening make recession the price to pay for beating inflation? We will ask Ben Emons of Medley Global Advisors. And Joe Biden becomes a symbol in the fight against COVID. The president is being isolated after testing positive and experiencing mild symptoms. The White House is confident that he will avoid the worst of the illness thanks to vaccines and a therapeutic drug. I'm Anna Edwards in London, Matt Miller and Kaylee Lines in New York. Matt, clearly, I'm sure that the president's battle with COVID, mild as it might be, will be one of the talking points today through the session, although COVID not the threat it was in pre-vaccinated societies, of course. From a market perspective, we're dealing with a lot of negative news flow, US data and European data.
Yeah, I feel like we're kind of over the COVID thing. The president got it. It's no big deal. He's still doing his work. In terms of markets, we have the S&P futures down right now, but 39.90. So we're getting closer on the S&P to 4,000. It's been really an incredible week, although as Kriti Gupta was just saying, we're not seeing the breadth anymore that we were seeing just a couple of sessions ago. Nonetheless, seems like it has been a rally that held with conviction. Snap may break that, and we'll see in just about 4 hours from now. The 10-year yield coming down really drastically. Kaylee pointed this out earlier. I mean, we were around 3% pretty much the last couple of weeks and have come off 20 basis points in the last few sessions. So that's a real concern. NYMEX crude, not a real concern. Holding under $100, 96.18 is down another 17 cents this morning, and Bitcoin is actually up 1.6%. A viewer pointed this out. It's not from midnight. We measure the price from 5 p.m. yesterday. I can't believe I didn't know that. $23,482 is the level we see on Bitcoin. I also want to just point out that we're seeing wheat and corn prices come down. We're expecting an agreement to be signed this morning, our time, I guess, this afternoon, now your time, Anna, to allow the export of grains from Ukraine through the Black Sea, and that should obviously take some pressure off prices here in Chicago. Kaylee, what do you see in terms of pre-market movers?
Well, really, it's all about Snap this morning, Matt. Anna mentioned this, disappointing on revenue, the lack of advertising sales or the slowdown in online ad sales due to the weakening macroeconomic outlook really is what is weighing on the company here, as well as increased competition. The shares are absolutely tanking in early hours this morning. They were already down the better part of 70% year to date before the results. They're down another 29% in early hours. Absolutely brutal. And of course, there's not a great read through to other online advertising dependent companies, the likes of Twitter, which will be reporting at 8 a.m. Eastern, down about 2.5% at $38.55. They are still well below that $54.20 offer price from Elon Musk. And then, of course, we'll get results from Alphabet and Meta next week when all the mega caps report. They are both down as well in tandem with Snap, 4.5% for Meta, Alphabet down about 2.8%, Anna.
Let's have a look at where we are on European stocks then, Kaylee. And European equity markets gaining, not feeling too much of the negativity around Snap. So stocks 600 is up by 0.5%. We've had weak data coming out through Europe, and that's certainly weighing on the euro, down by 0.8%. It's causing investors to go into fixed income. If you look at the GMM function on the Bloomberg, you can see a big green column under sovereign debt as investors are piling into that sovereign debt. And it doesn't necessarily look like the setup to more hiking here in Europe. Maybe that weakness in the data has got a lot of people thinking about just how many hikes we're going to see from the ECB. And of course, we don't have forward guidance anymore, so we don't know what to expect really for September. So that's what we're seeing on the euro and the fixed income markets. Uniper is in focus. This is a big gas player, the biggest gas buyer in Germany, and it called on the government for support after the Russians turned down the flow from Russia into Germany. It meant they had to go out into the spot market and purchase gas at very high levels. There's concern about contagion from this particular business into others. We expect to hear at the top of this hour, into the early part of next hour, from the German Chancellor about what they intend there in terms of the bailout, Matt.
All right, so let's get back to our guest right now, or to our guest. Ben Emmons joins us, Medley Global Advisors Managing Director and Global Macro Strategist. So Ben, in terms of what we saw, let's start in Europe, from the ECB yesterday, what do you make of the 50 basis point rate hike? And now it looks like we may see another 25 or 50 basis point rate hike. So going from 0 to 60 in, 24 hours.
Indeed, Matt, and I think it's a response to inflation. They just published the survey of professional forecasters too, and those inflation expectations really ratcheted up. So that information was probably in their hands yesterday, and again, amplifying that they have to raise rates quicker, and why they made this move yesterday, despite the early signal of the 25 basis points. But if I look at that guidance that you're getting this morning from one of the ECB governors, then that reminds me a lot of what the Fed is doing too. 25 or 50, we're data dependent. As data points come in, we can then make a choice whether we should go a little faster or stay at 25. So I think that's what the market is taking it today. Those yields are down really, I think, in response to PMI data, rather than what the ECB did yesterday. But it is a clear sign that the ECB has really made a U-turn, I think, in that way, ratcheting up rates, catching up with the Federal Reserve in that sense.
Yeah, Ben, good morning to you. But how long can the ECB hike for? When you look at the manufacturing data out of France suggesting contraction, the German manufacturing and services sectors now showing contraction in those PMIs, and with the threat of the gas taps being turned off, okay, they were turned back on, but could they go again? I mean, there's a lot of uncertainty for the Eurozone economy.
Undoubtedly, and I think this is what people are in the dark with. What is the reaction function of the ECB in a scenario where this mild contraction you see now in the PMI data really becomes severe as this gas crisis does become worse, and that's something that we don't know yet. So I think the reaction in bond yields this morning is somewhat of a reflection of that. It seems to be all across the board, so peripherals and bonds doing the same move in yields. So that tells you that it's indeed a risk scenario that if the ECB ratchets up rates to catch up, yes, you have that risk of this double-edged sword, right? You're getting inflation not coming off that quick yet enough, and the growth contracts. So it is a risk for the Eurozone, no question.
There have been a lot of commodities in focus when it's come to inflation, Ben, in Europe and beyond. We've been focused a lot on grain prices, certainly in the early part of the Russian war in Ukraine. We were focused on the rising grain prices. They're coming off a little bit in expectation that we could get a deal. I mean, should we have high hopes or very modest hopes about what can be achieved between Ukraine and Russia as they try to free up the grain that is trapped in Ukraine right now? I mean, a demining activity, I assume, would take quite a long time.
Yeah, it does. I do think this agreement is quite relevant. It was picked up yesterday. I think this will start affecting markets really today, because if it does get to an agreement that's at least adhered to by Russia, because that's where the risk, of course, is that they back away from it again, then you're going to see more grain coming out of Ukraine faster, more. What we've seen so far is whatever has been exported is about a third or so of annually what they export, but through all kinds of routes that slow down the grain to where it needs to go to. So the futures market, as you see, reacts to this news now, and if you get more grain coming out of it, I would think that this would affect food price inflation in the next 2 months or so. That would be meaningful, I think, for financial markets.
Well, and it would be meaningful for the Federal Reserve that has told us they are reacting to headline inflation, because that's what people feel, food and energy costs. So on that note, Ben, if we're starting to see a cooling of some of those pressures and a deterioration in the economic data, are you changing your view of where we'll ultimately get to on Fed funds?
It's certainly a challenge coming ahead of us, Katie, because you're right, like this pressure on commodity prices seems to be now continuing. And we started mid-June with some caution. Now it seems to become more of a trend. So it will lead to ultimately, let's say, the pressure of headline inflation coming through. And as we know from guidance from the Fed, they want to see persistent decline for several months before they change the pace of tightening. That may start to happen then by September, right? As some of that data start to reflect that. So whether it will change the ultimate destination is not clear, because the ultimate destination isn't clear. What's the right Fed funds rate to truly get inflation back to 2% target? The Ballard's view, it should be more like 3 7/8 type of a Fed funds rate. That's still priced in the market, even though commodity prices are going down.
Okay, well, of course, we'll get more clarity on what the Fed is thinking next week with that decision on Wednesday. But of course, that's going to come in the middle of a ton of market cap in the S&P 500 reporting. You have all the tech heavyweights due next week. Could be a huge catalyst for the market either way, Ben, especially off the back of Snap's results overnight. How optimistic are you feeling heading into a big week of earnings?
Well, so far, the earnings have surprised mostly to the upside. You know, it's a tally of about 73% have reported. Now, that's not insignificant, because if we were in a recession, then those earnings, we would also be in an earnings recession. We would have, let's say, less than 50% of companies surprising to the upside. That seems to be consistent with previous recession periods. So that's, I think, the good news. But the bad news, obviously, is that companies like Snap do show, and same with AT&T, shows what's going on with the consumer and where there's retrenchment happening as a result of high inflation and uncertainty. And we're seeing it from, you know, tentative layoff announcements through big tech as one example. So it's a huge week, and it's important for the markets because we have come off a bottom for tech. You know, are we going to see this through with the Nasdaq, you know, higher here? I think, given the environment we're in with alleviation of pressure on inflation and yields, that there's some more room, but those earnings will ultimately determine the direction of Nasdaq, higher or lower.
Ben, thanks so much. Thanks for joining us. Ben Emons, Medley Global Advisors Managing Director, with us to talk about these markets. Excuse me. We'll continue to talk about the tech theme this morning. We'll discuss Snap's plunging sales with Rob Niaz, who is from Hoxton Ventures, founding partner there and former Google product manager. This is Bloomberg. Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Well, social media giants across the board are plummeting this morning after Snap's disappointing revenue raised concerns about the outlook for online advertising. This, of course, comes ahead of Twitter earnings out before the bell today and Meta and Alphabet earnings due next week. Rob Nyes, founding partner at Hoxton Ventures and a former Google product manager, joins us now for more. So all the stocks are down, but it's Snap getting absolutely brutalized, down some 28%. How much of this, Rob, is a Snap-specific problem versus a broader online advertising problem?
I mean, I think you have to assume this is going to be across the advertising industry, the online advertising industry. The worrisome thing, I think, for the industry overall is that Snap's numbers were actually up in terms of usage. So they're doing all the right things on the product side. The daily active user numbers were up about 18%, but earnings were flat quarter to quarter. So that says either consumers are buying less or advertisers focused on consumers are spending less. Either way, it's bad for the entire industry.
Are we seeing now real layoffs in this industry? I mean, I know we've seen hiring slowdowns or stories of planned hiring slowdowns for next year. Are you worried that they're going to really start to cut headcount?
It's definitely feasible. I mean, I think, for now, hiring freezes are the new layoffs that, for companies growing this much, they're constantly hiring. So not hiring means natural attrition leads to employee shrinkage. But I do think these companies have a lot of fat to cut. They've been profitable or making so much money the past decade that, they probably are overbuilt. So it wouldn't surprise me to see some layoffs happening.
What about CapEx? Are you concerned that they'll slow down investment?
Hard to say. I mean, I think, for companies like Alphabet and Microsoft and the more enterprise-focused ones, I think they still see a lot of investment as being crucial. For the consumer-focused companies, I think they're going to be certainly pulled in that direction by the markets to cut some of the CapEx a bit and or cut some of the employee compensation costs through stock. I think there's no way around it. In a tighter market, you have to economize some way or another.
In terms of the Snap story and how it relates to other advertising-reliant businesses, Rob, you mentioned how this could be coming from a number of different drivers. But I suppose, is TikTok competition, is that a big deal? And does that tell us something about which other big tech names should be hit by this news and will be hit by the same dynamics?
So it certainly is. But I think the interesting thing here is that because Snap was actually growing, they weren't losing users to TikTok. So to me, that says fundamentally it's just dollars in the door on the advertising side. That's the problem versus the actual users. If Snap was losing users, you could point to TikTok and say it's zero sum. People are going to TikTok. In this case, Snap isn't really losing people. It's actually gaining people, which means, simply put, the advertising dollars aren't coming over the door.
And looking ahead, we're looking for numbers from Twitter. What are you going to be looking for there? Clearly, they're up against some of the same themes we've already talked about, but they also add perhaps internal distraction from all of the headlines around Twitter recently.
Yeah, I think there's a real question, have they taken their eyes off the ball for the while? It's a company that's always been a bit shambolic. I think the current distraction with Elon Musk have certainly made people distracted inside the company for political and whatever reasons. So not only do they have a question of the market being soft potentially among their advertiser base, they also have internal disorder.
In terms of what we've seen in tech, we've seen the same or worse in crypto. Rob, how do you view this crypto winter? Is it something that we're going to come out of? I just asked because Tesla, has sold another 75%. We were reporting 75% of its Bitcoin holdings.
Yeah, I think it'll be rocky. I think all these things are intertwined. That for crypto, it comes down to users or consumers putting money into crypto, and that's been the big driver of growth over the past 4 or 5 years since it's been gone up especially high. I think same thing. If consumers are feeling less confident, are they going to have savings they can put into crypto? And then with crypto prices falling, it creates a negative cycle of people seeing their savings account effectively going down, and it makes them less excited to keep saving and or think about cashing out. So I think it'll be a rocky time for a while.
Rob, we're heading into a big week for tech earnings. We've talked about some that are coming sooner than that. But what about, and the ones we've already seen, but what about the ones next week? What is the standout question for you? Is it about advertising weakness? What are you looking for?
I think it's advertising weakness and how much of it is consumer versus enterprise oriented. Companies like Alphabet have a lot more revenue they make from enterprise advertisers from the other tech companies selling software, among other things. So I do think part of the question is how much of this is isolated to the consumer side of the market and how much of it is broader ad tech overall.
Okay, thanks so much, Rob. Thanks for joining us. Rob Nyes of Hoxton Ventures. Thanks for your insights. We'll continue to bring you all of the details around what's going on with tech. Next week, we get an absolute deluge of earnings globally. We referenced it there. Big names from tech, also from finance, oil, aviation, and consumer goods report quarterly results. We'll bring you the latest news, analysis, and market reaction. Let me just tell you some breaking news coming through from Uniper. We'll have more details of this shortly, but Germany will end up holding around a 30% stake in Uniper. This is the gas giant that has been seeking a government bailout in Germany. And KfW, which has been giving a financing line to Uniper, will increase that credit facility to €9 billion. More on that shortly. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I don't think it's peaked yet, and our economists would say it's peaking. Probably is our team. Our team basically says that the Fed will continue to raise rates, and actually, Candace Browning-Platt team, the research team at Bank of America, has the year-end recession, which they made a call on a few weeks ago. But it's a slight recession, and a recession is not accompanied by high unemployment, which means it ought to right itself and come back out. But it's more the impact of the Fed raising rates and slowing economy. So it's peaking. It's probably more appropriate than peak.
Bank of America Chairman and CEO Brian Moynihan speaking to Bloomberg, talking about the trajectory for inflation. Tom Keene joins us, co-anchor of Bloomberg Surveillance. And Tom, we've seen a lot of volatility in all kinds of asset classes of late, and that's got a few people asking why we're not seeing more fear in the so-called fear gauge. I think you wanted to talk about the VIX.
Into the weekend,
the fact is it's a mini bull market. Off of the bottom, we're up 8-9%, 151% annualized off the middle of June. And I'm not saying it's a bull market, but the bears are sobered into the weekend. It's going to be very interesting to see the equity strategists writing. Here's a picture of it, the VIX. Going down is more optimistic. Going up is fear. The red line is that 40 statistic, Anna, which always indicates maximum fear, sweat, ratings go up, loads a boat, triple margins up. Yellow is a more cautious 30, where we visited often recently. And down we go, nowhere near the 15 level that was the bliss pre-bear market. But nevertheless, it's been quite a 6 weeks.
It's amazing that the VIX is so low, given Snap, the story is really about a reduction in advertising spend. Plus, we've had all of these, not layoff stories, but hiring freeze stories. And then yesterday, the telephone story I thought was amazing. The stock dropped the most in 20 years after AT&T said people aren't paying their phone bills on time.
I wouldn't conflate it, Matt. I think you're absolutely right about AT&T, and that's just one of those data points that you wonder about. They've got their own challenges, particularly against what seems to be a superior business plan at T-Mobile. But I take great issue with conflating tech into one pie. Snap, if you look at Snap's financial statement, basically it's a fiction, Matt. There's no profit model for Snap. There never has been. And it's a story stock about revenue growth and the rest.
All right, very interesting stuff, Tom. Thanks so much for joining us. Look forward to your program. Tom Keene talking to us ahead of the original Bloomberg surveillance coming up with normally John Farrow, Lisa Abramowitz. Kaylee Lyons is doing double duty today. Let's take a look at some of the other stories we're watching. I am utterly confused by the Tesla story. The most recent scandal from the EV maker is that one of Elon Musk's lieutenants apparently was buying glass, possibly for him. And there's a problem with that. I don't know if it's the kind of glass he was buying, the way he was buying the glass, the purposes for which he was buying the glass, but it doesn't make a lot of sense to me. Nonetheless, there is apparently an internal investigation, according to people familiar, and I'll be following this to find out what the deal is, because maybe I want to buy glass, Anna. Maybe I want to use some glass.
So maybe the market is confused as well. Well, I already got glass. I did a big project in my house, had to wait a long time for glass. Anyway, that's of no interest to anybody. Let me tell you what's going on in the gas story here in Europe, because I'm watching this, Matt. We just got these headlines that say that, well, we got details really about the bailout of Uniper. This is the reaction in the Uniper share price. Remember, it was up earlier, but it's been down 75% year to date. So this has been a pretty destroyed stock up to this point. They called for a bailout from the government. They've got that. The German government will hold a 30% stake in Uniper post the capital raise. They're getting an increased credit facility. And it's interesting because Uniper is so connected, too connected to fail, it seems, Matt. And this is the one that the economy minister said if it fails, it could be a Lehman moment for the European economy.
Yeah, it could be very bad for an economy that's already looking at some tough times this winter.
Yeah, absolutely. So that's it for Early Edition. More surveillance is ahead. Tom Keene and the team will be back with you, taking you through the Friday edition of Surveillance. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It would take a lot, I think, for the ECB to stop normalizing from where we're at.
The ECB has kind of backed into pretty dangerous territory here and arguably is on the precipice of a policy mistake.
They're hoping they can hike without triggering an even deeper downturn, but that's very much an open question.
I think the risk of the markets is that we talk ourselves into a recession.
The ECB is an incredibly tough place. All central banks are at the moment.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Farrow, together this Friday with Katie Lyons. Bramo back on Monday. TK Futures down 1/3% on the S&P. It's the end of forward guidance.
It's the end of forward guidance. We can talk about that and launch forward next week to a very important Fed meeting. But, John, we've got to do, what I see on the data screen right now is the shocking speed that we see in curve inversion. It's just absolutely stunning how we revisit new, greater inversion this morning.
What I see in the economic data over in Europe, Tom, it's pretty dreadful. The PMI is a downside surprise. That's not what you want to see. The day after we've had a 50 basis point hike, check out euro dollar, 101.57. Euro dollar negative 0.7%. Kit Jukes & Co. over at SocGen still calling this one, Tom, unbuyable potentially through the rest of this year.
Well, and it's on the GDP as well. I think, they've become massively data dependent after, I guess, what we saw yesterday. We'll talk to Jim Caron and others about it as well. Obviously, the market's not impressed. John, you and I saw that surge in euro, turns right back around, boom, down. And where we go from here, it is about economic data wrapped against, as Lagarde mentioned yesterday, the just original politics.
Tom, isn't it good news that we go meeting to meeting and stop pretending that we know what's going to happen in the future in Europe?
You're getting me going, John.
Isn't that good news?
You know where I am on this.
Well, tell me, would you make a Snapchat coming out and saying no forecasts, no guidance? We don't know where we're going either.
I just said to Matt Miller, the conflation of tech as tech is just baloney. There is profit-making tech and story stocks.
Kaylee, can we take a macro signal from the outcome of Snapchat earnings?
You might be able to, in that what they're talking about here is advertisers pulling back on spending because the macroeconomic environment is deteriorating. They are falling victim to that in a big way, but are they going to be a bellwether for Twitter later this morning, for Meta, for Alphabet, huge mega cap stocks, that report next week? And also I thought was interesting in those Snap results, they're slowing hiring. How many times have we heard that over the last couple of weeks, John?
Microsoft killing job openings. Kaylee, I have to say, though, isn't that the goal? Isn't that the objective of Fed policy? Isn't this ideally what they want? Job openings to be reduced, just take some demand out of the labor market?
Yeah, cool it off a little bit. In theory, yes. The question is, are they acting so aggressively that by the time the data catches up, we're seeing not just a cooling, but outright destruction in the labor market? And as we talk about where Fed funds ultimately needs to get to, where does unemployment need to get to in the scenario in which the Fed rate is high enough to get inflation under control?
The one thing in corporate comms that got my attention yesterday and actually worried me, Tom, was AT&T coming out and saying that people effectively are delaying paying their bills. That's something worth paying closer attention to.
I agree. It's a tea leaf out there. I would suggest also they have a little bit of competition with the guys in Magenta and all that. I just take massive issue, John, of media conflating Snap with name your big tech stock making gajillions of money. They're two separate worlds.
Big
But
tech
we've seen it in
next
Meta.
week. Go on, Kaylee.
We've seen it in Meta already, Tom, not just in terms of the advertising headwinds in general, but also those Apple privacy changes. They've been weighing on that stock for a long, long time, and that's one of those big tech companies.
Snap right now down about 30%. I'm going to whip through the price action. Kaylee's going to go through the day ahead. I think she tried to. I think she tried to briefly.
Can I go
Futures
home now?
down about 1/4% on the S&P. On the Nasdaq, we are lower by 1/2%. Yields in 6 basis points on a 10-year, 281.42 on a 10-year right now. Bramo would double down even harder than that.
You got that right.
Euro dollar 101.55. Kaylee, euro dollar negative 0.75%.
All right, I'm going to try and get myself out of the doghouse with Tom Keene with this morning brief. We got a lot going on this morning, 6:30 a.m. Eastern time, so just about 25 minutes from now, we're going to get a decision from the Bank of Russia. We have already seen 10.5 percentage points of rate cuts from April to June. We're expecting another 50 basis points today, although our economists here at Bloomberg Intelligence think the cut could actually be 75 and that the central bank is going to raise its growth forecast, lower the inflation one. What a turnaround for the Russian economy compared to what we thought the outlook was when they first invaded Ukraine. Then at 8 a.m. Eastern, we're going to get results from Twitter, just the results. There will not be a call because, of course, there's all that drama going on with Elon Musk. Will he be forced to buy the company for $44 billion? Looking at a share price of around $39. Doesn't look like the market believes it. But, of course, we'll be paying attention to what the advertising revenue and daily active users look like for Twitter. Are they falling victim to the same forces as Snap, where actually users are better? They're just not able to monetize them as much because advertising is slowing down. And then finally, at 9:45 a.m. Eastern, some U.S. economic data. We'll get the prelim read on PMIs for the month of July. We're expecting on manufacturing it to fall down to the 52 level. But of course, we've seen a string of downside surprises in the economic data over the last 24 hours or so. John, that is in part why we're seeing a big rally in the bond market. So will we see a follow through on the weakness in Europe when it comes to those U.S. PMI numbers later on?
Kelly, thank you. Pushing forward to that. And looking at treasuries right now, yields lower by 5 or 6 basis points. This range we've traded in the last 24 hours, the high of yesterday's session, 3.08%, right now 280. Jim Karen joins us, the Chief Fixed Income Strategist at Morgan Stanley Investment Management. Jim, that's a 27, 28 basis point trading range and without a major economic data release. What do you make of that?
Well, to me, what it looks like is that we're at an inflection point, and markets are essentially trying to figure out if they need to follow the nominal growth or the real growth. And the nominal growth, which has been, reasonably positive, but when you adjust for inflation, the real data is actually looking very, very weak. And we're seeing PMIs start to slip below or slip near critical threshold levels, and there's all the survey data that's suggesting that. So with a lot of cash in the system right now, people are very, very skeptical as to where to go. I think the bond markets have been places where, well, they've sold off, yields have gone up, and it's just attracting some buyers at this point because there's just a lot of uncertainty out there.
Jim Karen, you go right where I'm thinking about this weekend, which is you go to the sugar high of inflation. That would be Tang, and the sugar high that you get from it, and there's a point after the third Tang where it doesn't work. Discuss the nominal joy we're seeing right now versus the real of 2023.
Yeah, so I think it's interesting if we just put a couple of data points together, right? So we all know that wages have been rising, nominal wages have been rising. But if you look at real wages, meaning adjusted for inflation, when you subtract out inflation, they're down 3.4% year over year. We recently had a retail sales number that was a month-over-month number, which was pretty big, positive 1%. But then we also had in the same week a CPI month-over-month number that was 1.3%. So when you subtract out the 1.3 from the 1%, your retail sales is actually at negative 0.3%. So what that means is that people are starting to buy less goods, but they're paying more money. This is going to start to weigh on inventory adjustments which is going to weigh on GDP. This is not good for profit margins. This is not good for earnings. So the real data is actually telling us, forgive the pun, the real story, which is that things are starting to slow down more materially than maybe what many in the markets are thinking.
Okay.
And certainly the nominal data doesn't suggest.
What does that mean for the Fed then, Jim? Because what they are trying to achieve is a demand slowdown. If that is already starting, does that mean they're not going to have to go as far?
Yeah, so that's the crux of the matter, Kaylee. And I think that, no, they will go as far. And the reason is, and this is what's different this time, the Fed is hiking interest rates into a known slowdown in the markets. This is something that they don't normally do. I think they only did this once in the past 50 years, and it was in the 1970s. This is almost unprecedented. So the Fed sees this as an inflation problem. The Fed sees that they have to bring down inflation at this stage. And I think fully they're willing to go 75 basis points in July, possibly 50 to 75 in September. And they're going to keep going up to, in my view, up to about 3.75%, or maybe even a little bit higher by early next year. So despite the fact that we are slowing, are we slowing enough to actually get inflation to where they want it to be? And I think the answer to that at this point is no, they're not. So I think they're willing to be aggressive, even in the face of this weakness.
So what do you make of the easing of financial conditions we've seen in the last couple of weeks then, Jim? What do you think their reaction to that will be?
So, I'm a little bit mixed on this one, because I think people are very happy about the fact that, maybe interest rates have stopped going up. Look at what's going on along the yield curve. Tom was just talking about that. And I understand that when interest rates go low and people think that they're going to be somewhat stable, that people start to move into growth equity, and that starts to bring up the equity indice prices. People start to move into high yield. High yield spreads have started to come down. People start to look for yield because they believe that the thrust higher in interest rates is over. But what I think they're not thinking about enough is, why are rates going down? They're not going down for good reasons. They're going down because the economy is actually slowing. So I see this as a little bit of a sugar high. I see this as okay, rates have stopped going up. I'm very, very happy about that. Let's go buy something. But, why are rates going down? For not very good reasons. Maybe I should rethink this. So I'm a little bit skeptical on this rally at this point for those reasons.
Jim, let me squeeze this one in. After the news conference finished yesterday with President Lagarde, what did you and your team say to each other? Just the first words that left your mouth. What were you thinking?
I have no idea what's going on. There was just very, very little detail that was put into this transmission protection instrument that it really made it seem like they just opened the door to say, look, we're going to hike interest rates, but we have this other tool in case there's a problem, and it's a big tool. Don't worry about it. We got it. The ECB clearly wants to live in the moment and govern that way.
Jim, I like what Marcus Ashworth said at Bloomberg, writing in Bloomberg Opinion, TPI, to protect Italy.
I thought
that's all this
awesome.
about.
That's awesome. Hey, Jim, it's great to catch up, buddy, as always. Jim Caron there of Morgan Stanley Investment Management. But good morning to you. TK, that seemed to be the takeaway yesterday after that ECB news conference.
Please.
People's heads just spinning. My head was about to explode. If I hear TPI too many times today, I think it's going to go that way, Tom.
A family member, an acquaintance of a family, I should say, had a monograph from 1945 in Oxford of Jean Monnet. Nothing's changed since then.
Still
There's
confused.
nothing more than the political confusion off the memory of World War II, and it's a mess. I thought Lagarde did well yesterday, given all the conflicting politics she faces.
Euro weaker, euro dollar negative 0.75%. Futures down just a little bit after a decent run of gains on the S&P. We're lower by 0.25%. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. U.S. social media giants are on track to lose $69 billion since yesterday's close. Disappointing revenue from the parent of Snapchat raised concerns about the outlook for online advertising for the whole sector. Snap sees a major slowdown in the ad industry, and the company is planning what it calls a substantially reduced rate of hiring. Commerce Secretary Gina Raimondo warns that the U.S. can't keep relying on Taiwan for semiconductors. In a virtual speech to the annual Aspen Security Forum, Raimondo said Congress needs to pass legislation to support the domestic production of high-end computer chips. She called the $50 billion package, quote, a Sputnik moment for America. In the UK, a new poll shows Foreign Secretary Liz Truss extending her lead over former Chancellor Rishi Sunak in the race to be the next Prime Minister, according to a YouGov survey of Conservative Party members, 62% said they would vote for Truss and 38% went for Sunak. An earlier poll this week had Truss leading by 19 points. Turkey says an agreement to allow shipments of Ukraine's grain will be signed today in Istanbul. Ukraine, Russia and the UN will sign the accord. Ukraine's grain shipments have been largely stalled as its ports have been blocked since the Russian invasion. That's led to predictions of an increase in world hunger. And one of Elon Musk's top executives at Tesla is the subject of an internal investigation. Bloomberg's learned that Omid Afshar is being looked at for his role in a plan to buy hard-to-get construction materials. He's the executive who runs the company's Texas factory. Tesla has already fired some employees in connection with the matter. Meanwhile, terms of Afshar's departure are being worked out. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Earnings season is here.
Buzzwords this earnings season: recession, inflation, foreign exchange, layoffs.
We are starting to see, well, the world get a little bit more cautious about what these earnings are going to look like.
Bloomberg breaks the numbers first.
Second quarter earnings at Delta Airlines missed expectations.
When that inflation print hit, my eyes were on Amazon in particular.
With exclusive expert analysis.
The issue here really is elevated costs.
If you take a look at the projections, that is the story.
Bloomberg Television and Radio, the fastest numbers and analysis you trust.
We decided to raise the three key ECB interest rates by 50 basis points and approved the transmission protection instrument. We expect inflation to remain undesirably high for some time, owing to continued pressure from energy and food prices and pipeline pressures.
Go back to bed, get under the covers. The ECB is hiking interest rates. Christine Lagarde there, the ECB president, or maybe go back to sleep because, you know, that's what it felt like in the news conference at times yesterday, Tom.
Oh, it was not a snooze
as they worked through TPI.
I hung on every word.
I bet you were. Did you even carry that news conference on radio?
We did carry the news conference.
How much
and
of
then
it?
we were very,
How much of it?
Oh, I don't know, 90 seconds. And then we were very, very fortunate to have Marcus Ashworth to join us and really break it down. I think there was a lot of really good comment across all of business media. I think what Martin Arnold did today in the FT was great, John. And guess what? As we heard from Jim Caron, it's a big so what. It needs to be tested, and when it's tested, good luck with that.
I think BofA said from whatever it takes to whatever.
Yeah.
After yesterday's meeting.
We'll
Futures
see.
down
It's
by
original.
a third of 1% on the S&P. On the Nasdaq, we're lower by 0.6%. Katie's got a lot to say about what's happening with tech names. We'll get to that in a moment. We're down 6 basis points on a 10-year stateside. The Bund market. Let me just tell you where 10-year Bunds are, and we'll build on this later. We're down 19 basis points at the front end. The 2 years down 19 basis points. Euro dollar negative 0.8%. Tom, the PMIs out of Europe today were just terrible.
Yeah.
Let's be upfront about it. They were just bad.
23 basis points on the German 2 years, what I see 0.45%, and that shows a transatlantic divide that we've got. We've got a divide in Washington as well. Bloomberg's Joe Matthew briefs us right now. Joe, I don't want to do the postmortem on this conference. Everybody's doing it, this, that, everybody's got a political view. I want you to answer for our domestic and our international audience, what's the so what here? Where is this in September or December or in the history books?
If you're talking about the January 6th committee, come September, apparently we could get more hearings. We understand last night there, from members of the committee, more witnesses are coming forward, more evidence. Liz Cheney says it's the dam that's beginning to break. Here's the thing, timing is a real problem here. We were supposed to get a final report from this committee imminently. Last night was originally going to be the grand finale. Now we know it's not. There'll be likely more hearings come September. So they're going to drop an interim report. What happens if Republicans take control of the House in November? They're going to dissolve this committee, and they're going to turn it around and investigate the investigators. That's where you're going, right?
I want to know outside, Joe, you're really good at this. You get outside the Beltway. It's hard to believe, folks, but he hasn't taken all the Kool-Aid yet of the tang of Washington, D.C. Joe, what's the so what of this in the history books other than Democrats feel this way, Republicans feel that way?
Well, look, if you're talking about sedition and witness tampering, if that's actually provable from this White House, that's a big deal. The committee has two different purposes. One is to set the record straight. You're a history buff, Tom. We want to know what actually happened to keep it from happening again. Then separately, there's the matter of legal action, and that's going to come down to the Department of Justice. They are conducting their own investigation. It's just unclear exactly how, if this committee actually dovetails with that investigation and if they're providing information in the end. Liz Cheney wants to. Benny Thompson, the chair, says that's not their job. They just are here to set the record straight. Merrick Garland can do what he wants. But it's going to be an interesting bit of timing here because this could all be concluding on the eve of the midterm elections.
Well, to that point, Joe, and you mentioned Liz Cheney, she's feeling the heat from deviating with her party here. At least Adam Kinzinger isn't seeking re-election, so he can't feel that burn. I mean, how much does this influence voters in November?
Well, with regard to her own race, that it is its own thing in Wyoming, and a lot of people are wondering how many Democrats might actually vote for Liz Cheney. But look, she could be in big trouble. She could also be setting herself up for a presidential run down the road. That remains unclear. With regard to the midterms themselves, though, we started this segment talking about interest rates and inflation, and that's where the conversation is going to begin. That's where decisions are going to be made at the ballot box. It's not going to be likely driven by what this committee is doing.
All right, Joe, obviously the other news that hit the wires yesterday was that President Biden has tested positive for COVID-19. I remember when President Trump tested positive in October of 2020. That was a completely different moment in the pandemic, completely different in the news cycle. It was all we could talk about for days because we didn't have advanced vaccinations or treatments yet.
That's right.
It doesn't really seem like anybody's paying that much attention. He's doing fine.
Well, a lot of people are paying attention here. I mean, you're dealing with an almost 80-year-old man, and there are obviously some concerns about his health. But the White House was quick to kick out images and then, of course, the video of the president to reassure the world that he's fine. He is isolated in the residence and apparently working hard. Every image is he's behind the desk and doing something here, and that's the way this goes. But the messaging from the White House is really striking here as we look at where we were a year ago today. Joe Biden was in a CNN town hall, and he said that you won't get COVID if you take the vaccine. And fact checkers played with that at the time. Yesterday in the White House briefing room, Karine Jean-Pierre said, we expected this was always going to happen with regard to the president becoming infected. We never heard that before, not directly, but also sooner or later, everyone is going to get it. That's the first time I've heard that from a White House official, certainly in this administration that was partially elected to beat COVID.
Joe, we'll catch up with you in the next hour for sure. Bloomberg's Joe Matthew down in Washington, D.C. Tom, if there was a sign of progress around this pandemic, wasn't it this in the last 24 hours, to Katie's point, the way it was treated?
You know, Lauren Sauer is going to join us here, but I just think it's really, really bad medicine. If you get vaccinated, that does not diminish the opportunity to enjoy COVID. What it means is, when you get sick, you get much less sick, particularly with the double boosters. John, what I note there is, the president gets COVID and everybody goes nuts. I got COVID. I didn't even hear from you. I got nothing.
Yes, you did. I mean, don't say that. Yes, you did. Every single day.
Okay, you sent me a fruit basket.
I called you multiple times a day to check in on you.
Please.
Don't even start. Not even going there. Futures are down 1/3 of 1%. On the S&P. On the Nasdaq 100, we're down 0.6%. This weakness in the euro is something we've got to sit on.
Yeah, okay, sit on it, please. 101.
We're down 0.75 of 1%. The data out of Europe is just bad. And for those people out there saying you're going to talk us into a recession, I'm not talking anyone into anything. Just look at the economic data out of Europe right now, Tom. It speaks pretty loudly, pretty clearly.
John, can we get ready for the real yield this afternoon, folks? It's not as good as a crypto show, but we do enjoy it.
I agree. Thank you.
Yeah, thank you. The real yield here. I just want a victory lap for Priya Misra. We hit negative 0.25, 25 basis points of inversion at about 4 a.m. this morning. John, this is the banner. Folks, on radio, the banner says, halfway to Priya Misra. John, I never thought I'd say that this quickly.
She was looking for negative 40. I believe she still is. She thinks maybe the inversion can go more deeply than that, arguably because rates have got to go up more and the front end's going to suffer. Tom, that's the view of Priya and the team over at TD. Futures are down 1/3 of 1%. Crude, 95.29. We're down a little more than 1%. From New York this Friday morning, good morning. This is Bloomberg Surveillance.
worries about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Three-day rally on the S&P 500, actually a decent winning streak. You tally it up, we're up big time. On the week by about 3.5%. Futures right now down by about 1/3 on the S&P. On the Nasdaq, we're down 0.5%. Katie's going to go through the social media stocks a little bit later on, but Dan Ives of Wedbush already out this morning saying, don't look at Snap. Snap is a paper plane in a windstorm. And what you want to look to are things like Google and Facebook next week. We'll do that. In the bond market, this is what we're looking at right now. Big range on a 10-year Treasury. Yields right now, 281.97, pushing 3.1% at the highs yesterday. Yields come in 5 or 6 basis points. Look out for the PMIs a little bit later this morning. Look out for the PMIs a little bit earlier this morning over in Europe, and check out how Europe is trading. Just look at the bond market in Germany. Yields in 22 basis points on a 2-year, 22 basis points after the ECB just hiked 50 basis points and teed up another move in September. The euro negative 0.75% at 101.55. And Tom, the data out of Europe, ugly. Let's put it that way. Well, if you want to pick a word, ugly.
And Marcus had a nice chart today in Bloomberg Opinion. I'll get it out on Twitter, folks. Marcus doing a great job. John, the GDP, real GDP hurdle, there's totally different, radically different than the United States. The inherent dynamism isn't there, even though everyone you and I know, John, is going to Paris.
And the big number one shock, Tom, I know you're complaining because you want to go to Paris. The number one shock that we face in the second half could be a negative supply shock. And what could happen here, given the communication we got from the ECB, can you imagine this, Tom? That you get a shut-off of gas from Russia, or a near shut-off, and this ECB ends up hiking rates because of the inflation story that comes off the back of that. I mean, talk about hiking into a mess. Tom, you say they're data-dependent. Fine, I'm with you, they are. Totally. For you to understand what they do with the data, you have to have a decent understanding of their reaction function. And if you don't understand that, then it's all meaningless, Tom. You sit there, you say you're data dependent, then you cherry pick the data and what it means to you.
I look at reaction functions now, John, just like I look at the Sharpe risk-free rate. I mean, what is it? What's the risk-free rate right now?
In Germany?
Let me know.
Your 10-year right now is 1%, if that's what you're talking about on a risk-free rate, Tom.
I'd even go, you got to go short-term papers and anchor, and I don't know. I mean, I'm looking at the 2-year yield about ready to go negative in Germany.
Plus 46. We're getting there.
Are you done or what?
You keep bringing new stuff up, so I keep giving you numbers.
Okay, give me some numbers. Continue.
What more do you want?
What do I want? I'd like a ticket so I can watch the real yield this afternoon.
You can come and anchor the show if you like.
Folks, you got to see this. At the real yield, they've got chairs lined up like 3 rows deep.
There's a gallery.
It's like, it's a Foo Fighters concert.
There's a gallery.
And they got the gallery thing going, and everybody wears the ticket, the real yield ticket, and they take it home
Would you like to anchor it today? Because it's going to be a hot one, and I'd like to play golf with Brian Levitt.
Let's go to Brian Levitt right now, who's got a really, really sharp scenario-based mid-year view. Invesco does that so well. We should point out Levitt of Michigan is not on speaking terms with our Emily Wilkins of Michigan State. They've never spoken and sort of walked by each other carefully. Brian, I want to go to your wonderful mid-year review and scenario analysis. How do our listeners and viewers do scenario analysis given so many uncertainties, including war?
I mean, I think you need to look at it from the perspective of the cycle is challenged. We know that high inflation and policy tightening raises the prospect of a pretty significant slowdown, and even some indicators in the bond market suggesting a contraction. Now, so that a mild recession is certainly in the offing. But at the same time, the market has priced in a decent amount of it. I wouldn't say all of it, a decent amount of it. You're starting to see inflationary pressures, or at least inflationary expectations, come down, which could start to provide some clarity on policy and set the stage for a recovery.
Brian, let's get to July 27th here right now. You have a fabulous chart in your deck showing the distinctions of the four central banks, who's tightening, who's not. How alone is Jerome Powell after what we saw yesterday with Christine Lagarde?
Yeah, I don't think he is alone. And, policymakers in the Western world are going to need to do more, unfortunately, to bring inflation down. And, I heard you talking about this coming into it. They're now raising rates into a slowdown in the United States, certainly, and unfortunately in Europe, even worse than that. One of the places where you are seeing policy ease is China. And so China's had back-to-back rough years in the market because of the regulatory environment and because of zero COVID. And so easing policy in China is a tailwind, whereas we're still in the Western world grappling with the headwind of ever tighter policy here.
Okay, well, talking about those headwinds, as you say, they're hiking into a weaker economic environment. The bond market seems to be having a war with itself for that reason, Brian. Yields keep trying to go up because rates are going to go up, but at the same time, that concern around a potential recession or at very least a slowdown is keeping yields capped. Where is your assumption about if we've seen the peak in yields and if that means you actually want to be buying bonds here?
Yeah, I mean, I believe that we've probably seen the peak in yields. I mean, the way it plays out when you're in a recovery and expansion, and we were certainly in a high nominal growth environment, interest rates move higher, equity valuations adjust. What you're seeing now is short rates, which have moved up a lot since last fall, and may need to go a bit higher depending on where the Fed goes, but long rates start to stabilize and even come in amid expectation of lower inflation and slowing economic growth. So what worries me is investors see their statement and they see that, if you think of it in terms of 60-40, the 40 didn't work this time. Well, this is a very unique pandemic cycle in which we had a rate adjustment, but I wouldn't be selling my government bonds or my quality municipal bonds here. Duration's likely to be your friend in a slowdown.
Is growth in equities also your friend in a slowdown, Brian?
Yeah, defensive, higher quality, growthier businesses tend to do well in a slowdown. It's the recovery expansion phase of the cycle where you want to be very cyclical. When you slow down, more economically sensitive parts of the market tend to do less well. So investors that have been piling into things like energy and materials probably are doing it at somewhat near the high, whereas more growthier businesses tend to do well when they don't require as much economic activity.
Brian, over the weekend, strategists have to write about a mini bull market. On the Bloomberg screen, 12 months trailing, S&P and Dow are above a correction level. They're down 8%, 7%, 12 months trailing. I mean, there's a point where you have to blink and say, should I be more in equity, more on board, more a level of enthusiasm? Where are we right now in that mix?
Yeah, it probably depends a little bit on the time horizon. If you're buying now, you're probably not all that unhappy a couple of years from now. Do we have more room to go here? Yeah, I suspect we do. We haven't seen the traditional market bottom indicators flash, whether that's a VIX at 40 or put call ratios higher. There's probably a bit more room to go. We've had the valuation adjustment. Now we likely need to adjust for some earnings pressure. But the way I tell people, if you think of the average peak to trough decline associated with recessions, the last 10 recessions, it's 31%. Peak to trough, the S&P did 23.4. So we've done a good amount of what the average is. And averages lie because it includes 08, 73, 01. I don't think any of us expect severe recessions like that. So if it's a more mild variety one, yeah, there may be a little bit more room to go. But, you don't have to get the bottom as an investor. Even buying halfway or more than halfway through for long-term investors pays off very well.
Okay, so if there may be some more room to go, let's talk about the room to go for the dollar, because right now it's heading for its worst week since May. Is the peak in, Brian?
I would suggest probably not. I mean, the dollar has responded to a move by the European Central Bank. I mean, you look at the dollar indices, they're going to be trade weighted, so the euro is going to be a big part of it. And ECB raising rates more than expected leads to an adjustment in the dollar. But the currency is going to flow to where it's treated, or capital is going to flow to where it's treated best. And the United States, yeah, we have some challenges on the economic front, but certainly not as severe as what you're seeing in Europe. So still think the dollar is likely to be strong relative to its larger trading partners.
What do you make of life in asset management, Tom? Wake up early, do an interview with us, go and play golf at 11 o'clock. Is that attractive to you?
I'm playing golf. I'm playing golf with clients.
With clients, of course.
They're taking in 200 basis points per year. It's like it's easy.
Brian Levitt of Invesco. You go play golf with clients. I know. Brian, thank you so much. On a Friday, Tom, just perfect time to go and play golf with clients.
Can you see me on a golf course?
I can't. You used to caddy, though, didn't you?
I caddied big time. People will know Oak Hill Country Club, where Lee Trevino won the U.S. Open years ago.
Very
that
cool.
was one of my hangouts. And actually, there's scenes in Caddyshack that are hilarious. But no, they would like pay me to leave the golf course if we did like.
Do you make much money, TK?
Playing golf?
No, caddying.
Yeah, I did, because I could keep it from Nelson Rockefeller. It was great. It was all cash, and
good for you.
I was rich. It was it was in my youth. It was
many years ago.
Time ago. John, can we talk airfares? You talk
of course
about
we can. By all
supply
means, take
and
your
demand.
pick.
Everybody's
Spin the wheel.
living this. It's absolutely crazy. I heard from Bramo. She's on her way back. It's been, I guess, really interesting. Qatar Airlines from Kathmandu round trip business class.
Sure.
It's the only way Bramo goes. Is cheaper than New York to Paris. I find that
this is business
that just
class,
says everything
right?
about demand.
This is business class.
Yeah, what do you think? It's Bramo. What do you think?
I'm just asking to make sure because you didn't specify. Tom, this raises an important question about the back half of this year. This summer they've been able to charge what they want and people have been buying the tickets. I get that. We've been asking the question as to whether they can repeat the act later this year. And
I see him coming down a little bit. I had to buy a soiree to British Columbia yesterday that was not for me, thank you, but that was actually on the edge of reasonable. Thank you.
Oh, really? It came down a bit. Okay.
Yeah, I'm flying Air Kirby. What can I say?
What's that?
Air Kirby is United Airlines.
Okay,
yeah.
Scott's Airline.
They've been good.
I'm with you.
I got to admit.
Are we naming the airlines after the CEOs now?
Yeah, John, I called them up yesterday. I got them in 2 hours. I thought that was pretty good.
That's not bad. You just stayed on hold.
You.
Futures down 0.2 on the S&P. Honestly, getting in touch with these call
Scott, come on, we
centers.
got to talk.
Sort it out. It's ridiculous.
About my luggage in Des Moines.
Yields down 6 basis points on a 10-year, 281.97. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Trump insiders told the January 6th committee the former president ignored pleas to call off the mob storming the U.S. Capitol. The panel held a televised primetime hearing Thursday night. Members cast the former president's inaction as a desperate final ploy in his struggle to hold on to the presidency. And the White House is confident that President Biden will avoid the worst of the coronavirus thanks to vaccines and a therapeutic drug. The president is experiencing mild symptoms and has begun taking Pfizer's Paxlovid. He will isolate at the White House whilst continuing his duties. In New York State, the Republican candidate for governor was attacked at a campaign event. Officials say a man with a pointed weapon tried to drag Congressman Lee Zeldin to the ground before being subdued. No one was hurt. The attack took place outside the city of Rochester. And in Italy, an election will be held September 25th. In the wake of the resignation of Prime Minister Mario Draghi, President Sergio Mattarella dissolved Parliament and officially called for the vote. Following Draghi's move, a centre-right coalition is currently leading in the polls. And Turkey says an agreement to allow shipments of Ukraine's grain will be signed today in Istanbul. Ukraine, Russia, and the UN will sign the accord. Ukraine's grain shipments have been largely stalled as its ports have been blocked since the Russian invasion. That's led to predictions of an increase in world hunger. Amazon has started delivering packages to U.S. customers using the first of up to 100,000 electric vans it ordered from Rivian. The vehicle rollout began Thursday in 7 cities across the U.S. Amazon hopes to have the Rivian vans deployed in more than 100 cities by the end of the year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
lot of work done, going to continue to get it done. And in the meantime, thanks for your concern and keep the faith.
The president has COVID, and it's not the news event it would have been 2 years ago. That is progress. A lot of progress. Futures negative 0.1% on the S&P 500. On the Nasdaq 100, we're down by 1/3%. Yields come in 5 or 6 basis points to 281.97. Quite defensive out there in the bond market. The flow is going into treasuries, into bunds. Bunds aggressively lower. Yields down by 20 basis points or so at the front end. Euro weaker. Euro dollar negative 0.7% at 101.60. Just the data out of Europe, just not great at all. Downside surprise, downside surprise, downside surprise, and ahead of PMIs a little bit later, Tom, 9:45 Eastern time.
Right now, we're going to look at this. At the President of the United States, and as John mentions, it is way, way better than what President Trump confronted. Maybe age, maybe health, but also just virulence as well. Lauren Sauer is expert in this field, associate professor at Nebraska, their medical center, and director of Special Pathogens Research Network. Lauren, I want to go to our youth. I remember my mother dragging me in for boosters. It was no big deal. There was whooping cough, tetanus, there was diphtheria, DTaP and Tdap, and all the rest of it. Why is our fear over a COVID booster shot so different than our fear over getting a diphtheria booster shot?
To be honest, Tom, I think a lot of it is politics and the conversation around how the vaccine was developed. I think it's rare that we see the development of a vaccine play out in the public like this one has, where we're seeing every minutia of the stepwise path and where people are paying such close attention to the data that aren't scientists, that aren't clinicians, and they're sending out interpretations into social media or into the news media